Right, good morning everyone, and a very warm welcome to all of you to iFAST Mid-Year Review 2023. So my name is Terjun and I'm from the research team at iFAST. So this is actually the second year in a row that we're holding this event here at the Star Vista. And I can clearly remember that 1 year ago, I was up on this very stage to share the outlook for the second half of 2022. Now, if you look at the screen, you can see that the title of my presentation at the time was, "Your mortgage rate is going to spike to 5%. So last year, my presentation, it was mainly centered around two main topics. The first is inflation, and the second is interest rates. So we laid out our reasons for why we think inflation is in a structural shift, and decades of low inflation, it is coming to an end. And earlier this year, during our Invest Expo 2023, we also reiterated our view that both inflation and interest rates are going to remain high for longer, as central banks will likely have to keep rates high in order to bring inflation down. And if we fast forward to today, you can see that our view on these matters, they remain largely the same. So although headline inflation in the US has actually decreased, it is largely driven by a decline in energy prices. And if you look at core inflation, it still remains elevated. So as it stands right now, inflation, it is still far from the Fed's target of 2%. So persistently high inflation has also forced the Fed's hand as it raised rates by 500 basis points in a span of 15 months, as you can see from the table on the right. And this is actually one of the most aggressive rate hiking cycles that we have seen since the 1980s. And while the Fed has opted to pause in June, it revised its terminal rate forecast up from 5.1% to 5.6% by the end of this year. So this also indicates that the Fed is actually planning for at least 1 or 2 more rate hikes before the year ends. So Fed Chair Jerome Powell has also repeatedly said that interest rates are going to stay higher for longer, as the current outlook on inflation is still not supportive of a rate cut yet. So with the outlook largely the same as before, we decided to do things a little bit differently for mid-year review this year. So instead of repeating the same few points on inflation, recession, and interest rates over and over again, what we would do this year is to focus more on ideas that could do well in a rebound or even in the longer term. So this is why if you look at our program today, the ideas, the topics, they are mainly centered around longer-term investment ideas. And to start things off, I'll be sharing about one sector which we think has the potential to do well in the decades to come. So if you've been keeping up with markets, you know that equity markets, they have performed quite well year to date, despite slowing economic growth. So one sector in particular has done exceptionally well, and that is none other than the tech sector, or the digital economy sector as we call it. So as of the end of June, tech stocks, they have risen by more than 40% year to date in SGD terms, following the risk-on market rally and also the euphoria surrounding AI, which has taken the market by storm. So this AI frenzy, it actually started in late 2022 when ChatGPT was first announced. And a couple of months ago, NVIDIA also shocked the world with its AI-fueled sales forecast, which was more than 50% higher compared to the median analyst estimates. So even companies outside of the tech industry, they are also trying to cash in on this AI gold rush by bringing up the term AI in their earnings call. So an analysis conducted by Bloomberg News, it shows that mentions of AI among S&P 500 companies during the recent earnings calls have more than doubled in the recent quarters. But whether or not these companies they actually are involved in AI, it is another question altogether. But the thing is, with so many companies claiming AI capabilities these days, it makes it really difficult for investors like you to invest in this team. You don't know what you're buying into. So instead of investing into AI funds directly, we propose an alternative method. So back in the 19th century, during the California gold rush, there's a saying which goes, during a gold rush, you want to be selling shovels. So this saying arose when it became clear that the people who actually made money from the gold rush were not the gold miners themselves, but actually the people who seized the opportunity to sell things like shovels, pots and pans, jeans, so on and so forth. And if we apply this analogy to AI, the equivalent of shovels in this case would be semiconductors, and the people who are producing semiconductors are your chip makers like NVIDIA, TSMC, AMD, so on and so forth. So if you still don't catch my drift, essentially what I'm trying to say is if you want to cash in on the AI rush, One good way to do so would be through semiconductor companies. So semiconductors, they are the foundation of all electronic products, including AI. So AI systems, they rely heavily on modern technology, and they actually rely heavily on hardware that can handle multiple tasks simultaneously, such as your image and speech recognition, data processing, and also making complex calculations and decisions all within a short span of time. So all these functions, they require massive amounts of computing power that only the most advanced chips in the world can deliver. And as these AI applications become increasingly complex, the need for advanced semiconductor chips will also rise as well. And as of today, you can see on the screen over here that the market size for AI chips, it currently stands at about 17 billion US dollars, which is relatively small. However, estimates by various market research firms shows that the AI chip market will go through a period of exponential growth and reach close to 230 billion US dollars by the year 2032. So this is also equivalent to a compound annual growth rate of about 30%. So naturally, the AI rush will be a tremendous opportunity for semiconductor companies over the next decade. And again, this is one of the biggest reasons why we think investors can cash in on the AI story through the semiconductor sector. Now, for the benefit of those who are not familiar with this industry, I'll just do a brief introduction. So first of all, I want to make it clear that AI is not the only application for semiconductors. Okay? There are numerous other applications like your smartphones, your PCs, even cars nowadays have plenty of semiconductors in them. And all these applications will continue to drive demand for semis. So essentially, the companies that operate in this sector, they can be classified into four main groups. So first of all, you have your fabless companies. So these are companies that only do the design and they outsource the manufacturing to foundries to actually create the chips for them. So foundries are the companies like TSMC who take in orders from fabless companies like AMD and NVIDIA, and then they produce the chips for them. So in the middle of these two companies, you have what we call the integrated device manufacturers. So these companies, they do both the design and manufacturing. And the advantage of this is that they have absolute control over every step of the manufacturing process, and they can ensure that the chips are made to their specific expectations. And last but not least, we have your equipment manufacturers. So equipment manufacturers are companies like ASML, who produce things like EUV machines, which are used in the chip making process. So together, all these companies, they produce products like your memory chips, processors, sensors, so on and so forth that goes into all our electronic products. Now, let's take a look at how these companies have been performing this year. So year to date, share prices, they have done pretty well, rising by about 50% on aggregate already. So earnings, however, have not been able to keep up with this surge in share prices, resulting in expensive valuations for the sector. So on a forward 12-month basis, chip makers, they are currently trading at around 30 times earnings, which is considerably higher compared to its long-term average levels. And one of the main reasons why earnings for semiconductor companies, they have not been able to keep up is because the semiconductor industry is currently in a down cycle. So if you take a look at this chart over here, it shows you the semiconductor sales growth over decades. And you can see that the sector actually had 11 quarters of positive sales growth since 2020 before it turned negative in the fourth quarter of last year. And earlier this year, in the first quarter of 2023, sales growth fell even further, coming in at negative 20%. Now, while there are a number of reasons that can explain why sales growth has been falling, most of these reasons can actually be traced back to imbalances between supply and demand. So as many people were stuck at home during the early days of the pandemic, trends like your remote working were starting to gain traction, resulting in heavy demand for consumer electronics. At the same time, many businesses, they also made use of this opportunity to digitalize their operations. And the end result of all of this is that chip demand is unusually high, so much so that it caused a shortage somewhere in 2020 and 2021. So facing pressure from governments and also their customers, many of these semiconductor companies, they actually made commitments to expand their capacity. And as a matter of fact, if you look at the chart on the right, you can see that the total industry capex grew by about 30% in 2021 and 2022, and that is significantly higher than the growth rate of about 6% in the years prior to the pandemic. So not surprisingly, this sudden and sharp increase in capex has caused a supply glut. And unfortunately, the timing of this supply glut, it cannot be worse as chip demand is dissipating rapidly, resulting in a down cycle that we are seeing today. So the next question is, why exactly is chip demand falling? So it's no secret that the global economy is on a much weaker footing today compared to the start of 2022. So persistently high inflation coupled with aggressive central bank policy has slowed economic activity substantially, raising the risk of a recession. So the collapse of several US regional banks earlier this year has also added to concerns about the health of the economy. And as a matter of fact, if you look at the latest minutes from the Fed, they indicated that they expect the recent collapses in the US banking sector to trigger a mild recession in the year. So thanks to this greater economic uncertainty, chip demand has fallen drastically. Trapped between high inflation and higher borrowing costs, consumers like you and I, we have been cutting back on spending. And if you look at the data published by IDC, shipments of consumer electronics has actually declined in the first quarter of this year. So with the pandemic boom behind us and a global recession looming, consumer electronics, the demand, it is likely to remain weak for the foreseeable future. And if we look at the latest earnings calls of some of the more prominent chip makers like TSMC and Micron, for instance, they continue to warn of weak near-term demand as the inventory correction continues. However, the good news here is that down cycles, they don't last forever. So despite the current downturn, we are confident that semiconductor sales will eventually recover to higher levels than before, as it has done so every single time in the past. You can see it from this chart over here. And the reason for this is very simple, and it's because the world is becoming increasingly tech-driven. Therefore, we think that it is not a question of whether a recovery will occur, but the question really is when will this recovery take place? And by our estimates, we think that the industry could return to double-digit growth as early as next year. And according to estimates from McKinsey, the semiconductor industry is poised to become a $1 trillion industry by the year 2030, and that represents a compound annual growth rate of around 6 to 8%. And demand for chips, it is said to be driven by structural factors such as the increasing number of semiconductor applications and also the rising silicon content in them. So, for example, these days, the use of semiconductors has become widespread. Recent innovations like ChatGPT and the metaverse, these things are only made possible with advancements in semiconductor technology. So the rising number of smart devices in the world, it is also driving demand for semiconductors. And aside from this, the silicon content in most of the existing applications that we have has also increased significantly over the years. So one example would be cars. So even though cars, they are still largely mechanical since the start of the 21st century, thanks to new innovations like autonomous driving, the silicon content of cars today has increased tremendously. And it's expected to grow even further in the years to come. And according to projections by Intel, semiconductors, they actually make up roughly 20%, will make up roughly 20% of a vehicle's total cost by the year 2030, which is a 5-fold increase from 2019. So the bottom line is this. As the world becomes increasingly tech-driven, the demand for semiconductors will only become stronger than before. And no doubt this will bring immense benefits to the entire industry as a whole. Now, speaking of down cycles in the semiconductor industry, they come about once every few years. But when they do, it is a buying opportunity that is not to be missed. And I understand as investors, it is in our nature to try and find the exact bottom of share prices and to try to pick the exact bottom. But the reality is, it is almost impossible to do so unless in hindsight or unless you're incredibly lucky. So often, investors who are waiting to invest in catch a cycle bottom, they end up missing out on the opportunity altogether. So what we propose is, instead of trying to pinpoint where the exact bottom of the cycle is, what we can realistically do is to identify a range of buying opportunities in the cycle. And in our opinion, the best time to start accumulating semiconductor stocks is during down cycles when manufacturers are cutting back on production and preferably if share prices are at cheaper valuations. So as scary as things might seem during down cycles, we think that down cycles, they are a perfect opportunity for investors to pick up shares at a discount. Now, while there's no guarantee that share prices, it won't go lower in the near term, we are confident that they will be much higher than today in a few years' time. And that is, of course, thanks to the structural growth factors that I mentioned earlier. And if we only focus on current valuations in the industry, it will seem expensive as the industry is currently trading at around a PE of 27 times based on this year's earnings. But if we were to stretch our investment horizon out further by a couple of years, valuations are not as high as they seem today, as they're trading at about 17 times 2025 earnings. Now I know, 17 times, it is not exactly the most attractive number at this point, but we are already starting to see positive earnings revisions in the later years, which also points to a cyclical rebound in the industry. And if this trend were to continue, then valuations will become much more attractive. So overall, I think for an industry with such solid fundamentals, the growth prospects, they are simply immense. And while we understand that conservative investors, you may want to wait for more clarity before deciding whether or not you want to invest in this sector, we think that longer-term investors, you can actually start to build a position using a regular savings plan, and you can then switch to lump sum investments should valuations fall in the future. And to do so, investors can consider our recommended ETF, which is the VanEck Semiconductor ETF. So this ETF seeks to track a basket of 25 US-listed semiconductor companies, and it favors the largest and also the most liquid companies in the sector, such as the likes of NVIDIA, TSMC, ASML. I think if you look at the table on the right, you can see many names that you're familiar with. So one of the reasons we like this ETF a lot is because it has been featured on our focus list since 2018, as it consistently ranks the best among all the semiconductor ETFs in the market out there when put through our ETF selection methodology. So a couple of things that I personally really like about this ETF is its low expense ratio of just 0.35%, which is one of the lowest in the entire industry, and also high liquidity of roughly 7 million shares changing hands each day, so that you can ensure that investors can enter or exit positions without taking too much of a price impact. And lastly, I also think that ETFs, they are a great way for investors to get diversified exposure to sectors, and especially for those who don't have time to monitor multiple stocks, and of course for those who are not confident in your stock picking skills. So ladies and gentlemen, that's all I have for you today, and to conclude my presentation, I would like to remind everyone of the saying that I mentioned at the start, and that is, in a gold rush, you want to be selling shovels. And in this case of the AI rush, you want to be buying chip makers. So thank you all for listening. I wish you all the best in your investment journey, and I'll see you again next time. Bye-bye.
Hi, good morning, everyone. So thank you for coming to our media review. So I think today we have a very interesting topic. So I'm heard many of you know what are the Asian tigers of the past. So from the 1960s to the 1990s, 4 Asian tigers emerged, namely Hong Kong, Singapore, South Korea, and Taiwan, as they undergo tremendous growth and rapid industrialization on the back of a strong exports growth. And since then, these Asian tigers have taken a backseat as another economic miracle emerged, the Asian dragon, also known as China. So now that the Asian dragon is taking a breather, with China experiencing a slowdown in economic growth, I'm sure investors are curious, what are some of the new Asian tigers in mind? So with this in mind, let us dive into our discussion today and ask our esteemed and the panel speakers what they think are some of the opportunities in Asia. So the first question, why not we ask Grace? So what do you think are some of the Asian tigers of today?
Okay, so I think previously the Asian tigers, as you mentioned, the 4 different countries, Korea, Taiwan, Hong Kong, and Singapore. So they were driven by exports, high savings rates, and those has driven growth. But today we think that growth, I think, is driven a lot by consumption as well. So we have the big tigers, China, India, and we also have the emerging tiger cubs, so like Indonesia as well as Vietnam. So I think the story for China and India is kind of well known. So looking more at Indonesia and Vietnam, so do you know that Indonesia is actually the 4th largest, most populous country in the world? And it also has the largest GDP in Southeast Asia. And Vietnam is also an emerging power. So by 2025, we actually expect Vietnam to be the 3rd largest power in terms of GDP in Southeast Asia as well. So we think overall, Asia does have the best of both worlds. So first, we have a huge population. So 60% of the world's population actually lives in Asia. And secondly, we also have a huge consuming class. So if you look at by 2030, actually half the population, or more than half the population actually, will be in the consuming class. So we think that these are big drivers for growth in Asia. And actually, we also do think that rather than just limiting yourself to 4 countries, we also can look at small emerging tiger cubs that are present in Asia as well. For example, in Korea, we have HPSP, which is this small cap company. And what's interesting about the company is that it is the sole manufacturer of high-pressure hydrogen annealing equipment. And what's special about this equipment is that it supports high node for semiconductor manufacturing. So, and this is important because we need high node manufacturing for chips, because those are driven by, those will support AI server growth as chips as well. So we do think there's a lot of opportunity in Asia. So yeah, overall, we think that there's huge growth and potential as well.
Thank you, Hilda. So a nice name. So China, India, as well as Indonesia and Vietnam. So why don't we ask Hilda next? What do you think are some of your Asian tigers in mind?
Sure, thanks. So similar to what Grace has mentioned, I think if you're to think about the Asian tigers from a more original set of economies, they were actually driven, or their fast growth was driven very much by industrialization, exports, to a certain extent also education. So in this time of the day, I would say the growth drivers might be a bit different, but if you were to ask me what are some economies where I expect very high growth potential, in my mind, I would think Vietnam, India, and also Indonesia. So these are countries or economies which actually has already experienced very fast growth even before the pandemic. So take Vietnam, for example, I would say I would expect manufacturing to be a key driver of their growth. Increasingly, I see Vietnam as kind of like an outsourcing destination of choice for many companies who want to outsource their manufacturing facilities, whether it's to diversify their manufacturing facilities away from China or away from developed markets. As for India and Indonesia, I think a key strength of theirs is that they have a young and growing population. So their middle income population is actually growing and will be a huge driver of domestic demand for them. So that itself is a very strong structural growth. Particularly for India, I think the government has been very supportive of the digital and technology sectors. So that would likely be a very strong source of growth for the economy. And of course, last but not least, for Indonesia, it also has rich natural resources. So in Indonesia, it's the largest, it has the world's largest nickel reserve, and that is likely going to be a key reason that helps to propel them as the electric vehicle battery producer, or leading one within the world.
Thank you, Hilda. How about you, Oliver?
I would concur with both the prior speakers. I think Korea and Taiwan are for sure going to continue their manufacturing prowess, especially in the technology space. So I would consider them tigers for the next decade or so. I think Singapore and Hong Kong have matured, so maybe you're going to see slightly lower growth rates. So from a manufacturing perspective, I would expect things like Vietnam and Thailand, which is a big auto parts manufacturer, to actually step up and deliver decent growth over the next sort of 10 years or so. That's looking at it through one lens of manufacturing. If I look at it through more of a domestic economy perspective, and that's where I think the real opportunity is, you need to look at countries that have big populations, young dynamic populations, low credit GDP, and that's India, Indonesia, and probably Vietnam. So there's different lenses you can look at and different definitions for tigers, but for sure, Asia's an exciting place to invest, and there's lots of opportunity. I personally work on a Japan desk. Now, Japan definitely isn't an Asia tiger. It's a more of a mature market, but it is the 3rd biggest economy in the world, and it can definitely be a gateway into Asia for international companies, and it has a lot of manufacturing itself. So as we diversify supply chains away from China, Japan can for sure benefit. So Japan's in a good place, not a tiger in itself, but can definitely exploit some of the opportunities we're seeing in Asia.
Thank you. Some new names are Thailand and Japan. So last but not least, let's ask Kenny, what do you think are some of the Asian tigers of today?
Yeah, I have to say that my list of the Asian tiger is slightly different from the other panelists. So my choice of Asian tigers is Japan, South Korea, and Singapore, which is our country. So I think it's important to understand why, I would call this the Asian tigers. So some of the criteria that I have kind of like established to choose the new choice of Asian tigers. I think first of all, I think it's important to also understand that, the world has changed. There's a shifting geopolitics, the kind of standoff that you see between US and China definitely has important ramification on the Asian landscape. So who are the beneficiary for this shifting geopolitics? I think is important criteria. The second criteria which I would use is a lot of people in the past would deem that high economic growth would be the key to kind of like criteria to basically deem yourself as an Asian tiger. For me, I would rather use the word sustainable economic growth. Sustainable economic growth not necessarily mean high economic growth. So like, Japan for the past 2-3 decades, the growth has been terrible. I was in Japan, interestingly, working in Japan in the early 90s when the bubble just burst. At that point in time, the valuation of the Japanese market prior to the burst of the Japanese economy was more than 100 times. A lot of companies are in big corporate debt. So, but I think over the past 2 decades, what we have seen in a number of the Asian economies is that countries like Japan, countries like South Korea, countries like Singapore, they have been saving quite a bit. If you look at the corporate, the so-called the country balance sheet, one of the key indicators you look at is the current account surplus. So these 3 countries have been consistently achieving a very high current account surplus. So I think that is important because you don't have a good savings behind you. I mean, how can you sustain your economic growth going into the future? Because you can't just spend all the way on your reserves. So I think that is one of the other criteria. The third criteria, which I think is important, is the availability of world-class brand. I mean, you don't call yourself a tiger if nobody knows about you. So if only people knows about you through growth, then I think that is a very simplistic way of calling yourself a tiger. You look at Japan, they have world-class brand, Toyota, Sony, and a lot of the other brands that you think about, everybody knows. You talk to everyone in the world. And secondly, like Korea, you have your Hyundai, your Kia. It used to be very cheap cars, but now I know it's no longer that cheap. It's actually gone into the league to compete directly with the Japanese car. And the likes of Samsung, I mean, those people who don't hold Apple most probably will hold a Samsung phone. And I think the last but not least, I mean, Singapore, of course, you also have your Singapore Airlines, which is always the best airline in the world. And you also have your esteemed DBS Bank, who has been voted like world best bank for, I think, twice. So I think those are some of the criteria that I would call it important. So in summary, it's Japan, South Korea, and Singapore.
Right, so we do have some consensus on the countries, of course, some differences. So I think moving on to the next question, I think directed to Grace. So, in the past, the manufacturing sector has always been the driver for the 4 Asian tigers of the past. And in this day and age where technology is a key driving force for many nations, do you still agree that manufacturing prowess is the key factor for a country to succeed?
So we do think that manufacturing is important, but it's not the key factor. I mean, today we are seeing high-end manufacturing moved out from developed markets and low-end manufacturing moving more to emerging markets. So we do think that there are other factors in play, such as consumption. So like I mentioned, the big countries like India, Vietnam, Indonesia, they are huge populous countries. So consumption would help to drive growth as well. And just, I think, zooming on technology. So moving there, we know that R&D and patents are important. So when we look at South Korea and Taiwan, or more South Korea, I guess. So if you look at their patents in terms of AI and DRAM, so Hynix, SK Hynix as well as Samsung Electronics, they actually have 90% market share in terms of AI DRAM. So having IT is important as well. And not only just on IT, but also in terms of big data. So we think, for example, China actually has benefited given its huge population because they are able to get a huge data set to analyze. So companies like TikTok actually have benefited a lot from this huge data set because they have an algorithm that learns about you every 2 seconds, right? So TikTok probably knows you better than even your own mother. So so basically, because of all these big data consumption, we think that all these will help to drive growth. And one interesting fact as well is that China is actually the #1 in terms of AI patents globally filed. So they've even overtaken the US. So, we think there's definitely a lot of growth in Asia, and manufacturing, I think, is not the kind of key only factor, but there are other factors as well that would drive growth.
Right. So I think, how about you, Oliver? Japan is quite a strong manufacturer of many cars, etc. What do you think about Japan?
Yeah, so I think manufacturing is important. I think 60s, 70s, and 80s, it was probably the most important driver. Going forward, I think it's going to be the combination of technology alongside manufacturing. And Japan is in a pretty good place here. It has a long heritage of basic manufacturing, like materials, but also higher-end manufacturing. Used to be 50% of the semiconductor industry back in the 1980s. But as I look at Japan today, the labor force is actually reasonably cheap, very highly skilled. They've got big brand names, which the prior speaker alluded to. So I think they are going to be in a good place for the next decade to benefit from some of these drivers as technology increasingly permeates the factories and the data centers of the world. Japan has leading companies in automation and robotics. They export 50% of the global robotics. And those companies are called FANUC and Keyence, but they also have semiconductor testing equipment, materials companies like carbon fiber. So Japan, although, as I said earlier on, is not probably a tiger, it is very well placed, I think, to benefit from some of these drivers we're seeing over the next sort of 10 to 20 years.
Right. Thank you, Oliver. So I think I have a next question for Hilda. So following up on the previous question where we touched on technology, and of course, just now my colleague shared about semiconductors. So since semiconductors are essentially the bedrock for technological advancements, do you think it is important for a country to be a leader in the semiconductor space?
So I think being a leader in the semiconductor space would be a sufficient reason to lead to very strong growth within the economy, but it's not the only reason where a country can therefore get strong growth. So assuming you are an economy who has access to semiconductors and also provided you have the right policies, infrastructure, and workforce in place, then yes, semiconductor would be a strong reason that can help your economy to grow. But there's, within the value chain, there are so many different parts of the supply chain where economies can actually value add and therefore find their strengths in. So I think importantly, we have to, the key thing for countries or economies is that they have to play to their strengths. They have to really find where they actually can offer a competitive edge compared to other economies, and that's where they stand out and therefore can achieve sustainable growth. So take, for example, right now, AI is dubbed as the next technological revolution. So economies who are strong at that, take China, for example, they can therefore get or receive a huge source of growth from being strong in AI. And I think another important point or interesting point to highlight is that being strong in semiconductors doesn't mean it would naturally lead to good growth, because it also subjects you to quite a lot of volatility because you are vulnerable to global demand and also the chip cycle as well.
Right. Interesting answers and questions for the other countries. So I think let's end off with a last question for Kenny. So let's talk about home ground, Singapore. What do you think are some of the opportunities and growth ahead?
Yeah, I think Singapore, it has been an Asian tiger. We have experienced, past era of very, very high economic growth. Of course, right now, is on a more difficult patch. But having said that, I think the kind of foundation that Singapore has laid itself, I think it's important why I chose Singapore as a new Asian tiger. I think first of all, if you were to look at the current account surplus, which I actually mentioned, Singapore current account surplus is one of the most enviable in the world. You have double digit consistently for the past 2 decades or so. I think the difficult patch was in the early 80s, but after that, we have been saving up a lot of money. And I think Singapore also knows its limitation, that we don't have a vast amount of land, we don't have a lot of cheap skilled labor. So to compete itself in the manufacturing space is kind of like going to be tough, and I don't think it's sustainable. So what it has been embarking itself on is firstly on its role and status as a global financial center. I think that has been proven that Singapore has successfully grown itself, to be in the league of Tokyo, New York, London, Hong Kong. And again, I think this is something that I think the government has been using very proactive policy to basically encourage the continuing growth and expansion of this sector. And you can see some of the policies that they have implemented. And recently, because of the, of the concern in China, there has been a lot of wealth kind of relocation to other parts of the world. And Singapore has been one of the beneficiaries. Just some data for your perspective. Like, the Asian single family office, in 3 years ago, in 2020, there were only 400 in Singapore. And as of the latest data that we got, we already surpassed 1,100. So there has been a strong growth in terms of this wealth. And Singapore is also attracting a lot of foreign institutional money. The total AUM that we are managing is now $5.6 trillion. And this is the number from MAS. So I think that kind of growth in the financial center will continue, and the government will continue to proactively encourage that. And I think that will be important kind of area that we have to look at in Singapore. The other aspect of Singapore, which Singapore also understand that it has to diversify itself away from just over-reliance on a particular sector. So they have been also embarking on what I would call a new Singapore opportunities. So you look at, although it's not very well represented in the stock market at this point in time, but new opportunities in the space of technology, in the space of, for example, you've seen the first electric car that is actually being produced in Singapore, right? Or assembled in Singapore in that regards. And I think it's the Hyundai Ioniq, if I'm not wrong. And then also in areas of healthcare, in areas of data, in areas of logistics. So a lot of you will ask, let's say for your children, let's say if they go to the university, which is the best course that they choose that is the highest paying? Data science, data analytics. So this is something that, the Singapore is also trying to upgrade the skill set of its people so that they can actually be engaged in what we have seen in the other parts of the world where technology progress is very important, as shared by some of our fellow panelists. So I think these are some of the new initiatives that Singapore, which kind of give me a bit of confidence that we will continue to sustain our status as the Asian tiger.
Right, thank you, Kenny. So, Asia, Singapore, and a lot of the countries that our panelists have explained, there are a lot of opportunities ahead, so do look out for them in the years to come. I think with that, we've come to the end of the discussion today. Thank you, everyone, for your attention, and of course, to our panel speakers.
All right, hi, everyone. My name is Colin, Research Manager at iFAST Research and Portfolio Management Team. So Japanese equities have been on a blistering run, as many of you may know. So with the domestic equity indices like Nikkei or Topics hitting decades high recently. So this rally has in fact reassured our call for Japanese equities, which we have been positive on since last year. But despite this fierce rally, Japan remains one of the top equity market picks for us in both the near term as well as the longer term. So in this session, just let me share several key reasons why we believe Japan's rally has staying power. All right, so first, let us take a look back at the history of Japanese equities to first understand why we think Japanese equities will move higher. You can see that Japan's stock market has came a long way, in fact, very, very long way. So after the asset bubble burst in 1991, I'm sure many of you may remember, the economy went through a decade of stagnation, and on top of that, companies went into survival mode. As corporate earnings plummeted, you can see that by the black line over there. So many companies afterwards started to hoard cash. They became very prudent. They cut back on capex, they cut back on R&D, and also at the same time, they were also frantically deleveraging because many of these companies has high debt built up throughout the bubble age. So they have been trying very hard to clean up their balance sheets. So stock markets and corporate profits were in fact quite flat throughout the 90s. You can see that from the period over there, 1991 to 2003, which is the famous lost decade. So this finally ended in 2012 when Japan's economic regime began to shift after Abenomics came into play. So that happened around the end of 2012. So the economy experienced higher growth afterwards. Inflation began to pick up, like what we've seen recently. Tax rates were cut tremendously. And on top of that, companies' net gearing fell drastically as they deleveraged even more. And ultimately, corporate profits exploded higher. You can see from the black line there, we see that exploded higher and supporting the stock market's climb. So in short, you can see that the asset bubble burst. Afterwards, corporate Japan spent 10 years cleaning up and another 10 years to recover. So right now, it is at levels where we see almost back at 1991. So as we look ahead, we do believe that the market has what it takes to make the next climb. So over the next few slides, let me share the reasons why. All right, so let's start with the first reason, the ongoing reopening tailwind. So since Japan reopened, tourism spending and household consumption have been firing on all cylinders. So let's take a look at both of these drivers. So starting off with tourism, I'm sure many of you here have been to Japan since it reopened last October, and in fact, maybe more than one time as well. So before the pandemic, in 2019, the tourism sector contributed around 7% of the nation's GDP. So that is roughly equivalent to 360 billion USD. So let me put things into perspective. So this amount is almost equivalent to Singapore's 2019 GDP alone. So since Japan reopened, you can see from the chart on the left, the tourism has rebounded very, very fiercely. So over the past 12 months, since end of April, there has been a massive 330% increase in tourist spending, providing a huge boost to consumption. So despite this dramatic rebound, we do think that there is still room for tourist spending to climb. So right now, based on our estimation, there is the tourist spending is still 90% of its pre-COVID level. And based on Japan's official projection, tourism spending is expected to hit pre-COVID level this year. So moving on to consumption activity, the other important driver. We also find that domestic spending has been consistently higher throughout the past few years. So as shown on the chart right here, since Japan exited its state of emergency, consumption has been increasing steadily, and that is being led higher by services. In fact, Japan's higher inflation does little to impede domestic spending, as consumption has rebounded steadily in real terms. That is accounting for inflation. So you can see that from the chart on the right, the clear, strong growth in consumption after it reopened. So again, more importantly, consumption activity is still roughly around 91% based on our estimation of its pre-COVID trend. And that also implies that there is still much more room for consumption to grow back to pre-COVID level. And we are not even talking about surpassing pre-COVID level as we move ahead. All right, so looking ahead, we do expect a consumption-led growth in Japan this year, and we already can see that happening over the past 2 quarters. So with consumption around 2/3 of Japan's GDP, we believe this should compensate for weaker export numbers, and at the same time, it adds resiliency to economic growth. And during this period, especially when your global headwinds are mounting. So as a result, we do expect Japan to deliver stronger economic growth over the next 1 to 2 years as compared to other developed markets like the US and Europe. So our expectations remains aligned with consensus, which also forecasts Japan's quarterly GDP to surpass the peers as shown on the chart here. You can see that from the dark red line. So overall, we do believe Japan's rosier economic backdrop should provide very strong support for its equities, especially against developed market peers like the US and Europe. All right, so the next reason why we are positive on Japan is Japan's fundamental strength for its corporates. So since the COVID trough, revenue growth for Japanese companies have surged, while at the same time, profit margins have also hit cycle highs. So even during the most recent financial quarter, which in fact is quite challenging for companies around the world, more than half of the Nikkei 225's companies managed to either beat or deliver earnings in line with consensus. So as a result of this strong earnings beat, this has resulted in a U-turn in earnings revision for the Nikkei 225 index. So you can see from the chart on the left where earning estimates for the index have been revised higher, in fact, very recently. And this suggests greater optimism from analysts towards Japanese equities. So this can also be seen from Japan's rosier earnings outlook, highlighted by the chart on the right, and you can see that consensus expect earnings for Japan to grow by strong double digits over the next 2 years, far surpassing developed markets like US and Europe as well. All right, so we do think that analysts' expectation of strong earnings growth from Japan is deliverable, and this is expected to be led by the tech sector, the healthcare sector, financials, as well as consumer discretionary sector as well. So Japanese tech sector is well supported by two things. The tech sector is right now well supported by a rebound in semicon as well as software company earnings. So this is led by global names like Aventis as well as Trend Micro and NEC. So many of these companies that you guys may have heard of. And also many of you may not know that, but Japanese pharma as well as biotech industry are also world-class. So in fact, this industry has seen a surge in earnings during the pandemic, strong double-digit earnings, and is also expected to maintain strong earnings growth even during an economic downturn. So Japanese financials at the same time have also seen a surge in net interest income, which is due to a solid demand from capital from Japanese companies. So with this expected to continue, and also the likelihood of higher longer-term yields, Japanese banks as well as financial services companies are expected to maintain their earnings strength. And last but certainly not least, Japanese consumer discretionary companies. We do believe that there are a huge support to overall earnings growth. So many auto players like your Honda, Nissan, and many of these established names are seeing a revival in sales growth. And at the same time, other consumer goods company like your gaming company like Bandai Namco, for example, are also seeing a surging sales growth. And this is supported by strong consumption tailwind happening in Japan right now. So with all this support from major sectors, we do think that Japan's earnings outlook looks promising if you look ahead. Additionally, if you look at Japan's corporate balance sheets, we do see that they are in a strong position right now. In fact, as the chart on the left-hand side shows, the amount of cash for Japanese companies have surged 250%. So 250% over the past decades to record high. And this is because operating conditions have improved in Japan over the last decade, as I've shown in a chart, in my second chart. So what do I mean by that? If you look at the past decades, we see that margins have more than tripled. Corporate earnings have grown by almost 400%. Corporate tax rates were in fact cut by nearly 10%. And at the same time, borrowing costs fell drastically as the Bank of Japan went into negative interest rate policy. So another impressive feat, as shown on the right, is that close to 50% of Japan's listed companies are net cash. So what do I mean by that? Which is that companies have more cash than total debt. So these companies have more cash at hand. So more than 50% of Japan's companies are net cash. And this is impressive because it is more than double that of the US as well as European listed companies. So all these are important as Japanese companies are now entering an economic slowdown with cash-rich balance sheets, which they can deploy to either defend their operating performance or quickly recover for their businesses. And the third reason why we like Japan is also because of the stock market's room for valuation expansion. While valuations right now, as you may wonder, for the Nikkei 225 has increased after the rally. But what we see is that forward PE is only around its long-term average. So you can see that from the chart by the left. So this implies that valuations are still fairly fair right now. So also let's take a look at the chart on the right. So if you can compare Japan's equity valuation against the US, which has also rallied in the year to date, or even the developed market index, you'll find that valuations for Japan are much more attractive. So both the S&P 500 as well as the Nikkei 225 index has rallied about 18% in Sing dollar terms in the year to date. Both are about equal, and in the first 6 months. But US equities right now, they are about 12% overvalued, while Japan is only trading quite fairly. So while valuations are around the long-term average, we definitely see room for valuations to move higher. So if you look at foreigners buying and selling of Japanese equities, we find that foreigners have greatly bought Japanese equities right after Abenomics. As you recall what I showed earlier in my second slide, after Abenomics, the economy went up, the economy went strongly. And we can see that here, that foreigners are buying Japanese equities right after that period. But unfortunately, after that period, Japan went into the bear market in 2016 and followed by the trade war afterwards. So foreigners have been heavily selling Japanese equities for the past 6 years. So more recently, we see that foreigners have entered the Japanese market, seeing the strong growth as well as the better investment case. More foreigners are entering the market, but you can still see from this chart here that Japanese equities are still chronically under-owned as compared to what we've seen in the past decade. But also at the same time, if you look at data, it shows that 10% of Japanese households' assets, 10% of that are in equities, only 10%. And there is certainly more room for retail participation. So overall, should Japanese equities see more inflows coming from foreigners, coming from their domestic markets, we definitely think that valuations can move higher, driving equity upside. So this is very possible considering the corporate reform momentum that is going on right now, and also a potential exit from deflation, which many will cheer for, and also because of its earnings as well as economic strength. So beyond the near-term factors, we believe that the long-term case for Japanese equities has become much brighter, and that is adding to our conviction as well. So one major factor is that corporate reforms are making a breakthrough, as I've alluded earlier. So as shown on this chart right here, Japanese policymakers have made it an objective to improve corporate governance. So they have went to the companies and established laws to tell shareholders that, hey, please deliver more shareholder values for your shareholders. And this has been an arduous journey that started 10 years ago, as you can see from this chart here. But unfortunately, since the pandemic, these efforts were halted. However, as the economy reopened, policymakers are again making a strong push for corporate reforms. So this time, and more recently, the Tokyo Stock Exchange have begun pressuring companies with low PB ratios to more efficiently distribute their capital back to the shareholders or potentially be delisted. So this has been very effective, as many companies have responded with buybacks, more dividends, as well as improvement measures in the recent months. And those have benefited shareholders as of the recent past couple of quarters. So should policymakers continue with their reform efforts, we can see that Japan will quickly become a hunting ground for investors seeking stocks that are not only fundamentally sound, but also provide better shareholder value. So another bright spot in Japan is the banks. So there are several reasons why Japanese banks are well positioned. So let me first start off with valuations. So valuations for Japanese banks remains attractive as compared to the US peers. So the Japan's banking sector as a whole trades on the PB ratio of about 0.7 times. This is quite a stark discount to the US banks, which is trading at about 0.8 to 0.9 times. And you can also see that from the chart on the left-hand side, the yield curve for Japan remains non-inverted. So this is something that is very different from major economies like the US, for example, which are seeing inverted curve. So a non-inverted curve greatly buffers the net interest margin for Japanese companies. Furthermore, we do think that the Japanese bond yields, especially longer-term ones, have the potential to move much higher. So with the country's stickier inflation pressure and possibly an exit from deflation, we do think that there is increasingly high chance of the Bank of Japan making adjustments to its yield curve control and allowing longer-term yields to fluctuate higher. So to put things into perspective, if you look at US 10-year Treasury yields right now, they are close to 3.9%, whereas Japan's 10-year yield are close to 0.39%. So this is 10 times lesser, and therefore a new era of potentially higher longer-term yields in Japan should greatly drive Japanese banks' performance. As you can see from the chart on the right-hand side, higher yields has historically been a strong catalyst for Japanese banks, and we have a strong chance of entering a regime of higher yields in Japan. So another bright spot, and perhaps the most exciting one for me to end off, is the potential for Japan to take back the tech sector advantage. So we do think that this starts from its semicon industry. So right now, Japan's semicon industry is in a sweet spot, firmly bolstered by both your global as well as domestic factors. So geopolitical tensions, I'm sure you guys might be aware, over the past 12 months, over the past 24 months, and those geopolitical tensions have been rightly about the global chip supply, and they have motivated companies to re-establish and strengthen their own supply chain. So as such, many of these world's strongest, largest chip makers like Micron, Intel, as well as TSMC have made plans to invest in Japan, and also by building major plants and major R&D centers. So you may wonder why Japan? And the reason is fairly simple. So Japan stands out as an attractive destination due to its generous subsidies, well-developed infrastructure, skilled labor force, and also not forgetting the existing expertise in chip production. And also on the domestic front, the Japanese government is pushing to grow the local semicon industry. So for example, Japan's industry ministry targets to triple the sales of companies manufacturing semiconductors to 15 trillion yen by 2030. And with both the external as well as domestic push for Japan's semicon industry, we see the potential for accelerated growth in this industry over the next few years. And we do think that the revival of Japan's semicon industry will light the path for a potential tech push in the coming years. All right, so before I conclude, once again, here are the 4 reasons why we like and recommend Japanese equities. And looking ahead, we do think that Japan has what it takes to perform in the long run and expect the Nikkei to hit 40K by fiscal year 2025, which is end of March 2025. So this should translate to a handsome 26% upside potential as of the current prices. So with that, I've come to the end. Thank you for staying through this presentation, and thank you for your time.
Thank you. Good morning, everyone. Thank you for your time. I appreciate it on a Saturday morning. The prior speaker did a phenomenal job at, I guess, presenting the investment case for Japan. And I largely agree with most of what he said. So I'm going to quickly reiterate some of those key messages as we see it on our desk. And then I'll talk about how we actually invest into Japanese equities and talk a bit more about the fund and its positioning. So firstly, in terms of our outlook, the long-term investment case, I think, is robust. Okay, so year to date, Japanese equities are up 25% in yen terms. That's really strong. It's been a very strong 6 months. That's been driven by stronger earnings than people were expecting. It's been driven by more foreigners coming into the market and actually buying Japanese equities, partly as a hedge against some of the tensions in China and some of the softness in Chinese economic data, but also partly as a hedge against maybe a US recession later this year. So Japan is in a bit of a sweet spot at the moment. And that's a combination of both sort of short-term tailwinds and longer-term tailwinds. And let me talk you through those, because I'm sure everyone is asking the same question: is can this rally in Japanese equities continue? And if it can continue, to what level can you expect it to go to? In terms of the long-term fundamentals, valuations are still attractive. So they're still cheap relative to their own history and still cheap relative to other global equity markets such as Europe and the US. In terms of corporate reform, which the prior speaker touched on, this has been ongoing since Abenomics in 2013. So we're on a journey, okay? We're probably halfway through this corporate reform journey. Japanese corporates many years ago were terrible at allocating capital. They were terrible at cutting costs, and they were terrible at restructuring their businesses. But a lot of that has changed in recent years, and as we sit here today, I believe the corporate reform story is going to be one of the key drivers for the next 5 to 10 years for improving underlying profitability at companies. And that is the third structural sort of long-term point, is improving margins. Margins in Japan at the corporate level have always been quite small. They're improving, but from a very low base. They're still below Europe, far behind the US, and they can get better from here with some of those corporate reforms I mentioned. The shorter-term cyclical tailwinds which we've seen, which is sort of partly the reason why Japan has been in demand this year, are the fact that Japan was late to reopening from COVID. So they reopened about 12 months ago, but there's still pent-up demand for spending. I was in Tokyo a couple of months ago, and Ginza, the key shopping street in Tokyo, was really buzzing. Not full of tourists, but full of locals wanting to spend money. So there is that pent-up demand to buy things and travel, and people are actually using savings, their buffer of savings, to do so. The second short-term tailwind is China. So China was very late to reopening from COVID, and there's two reasons why Japan benefits from that. Firstly, Chinese tourists were a big part of the tourism industry in Japan. So as Chinese tourists come back to visit Japan, they will be spending money. They're big spenders on luxury goods, on cosmetics, and that will be beneficiary going forward from here as airline routes and visas open up again. The second reason China reopening is important for Japan is that China's economic machine is huge. And once that gets back up to full speed, there's a high demand for inputs into that manufacturing process. And Japan, although it doesn't manufacture raw commodities and base commodities, it does manufacture high-end inputs in terms of plastics, glass, carbon fiber, and chemicals. They've got a really big footprint globally for these sort of things, and that feeds into the economic machine in China. So we're seeing stronger demand for a number of the companies that we own in the fund. And the final sort of short-term tailwind is the removal of supply constraints. You'll remember during the sort of COVID lockdowns for a couple of years, semiconductor chips were quite hard to get. Getting hold of a brand new car was almost impossible. Buying a high-end camera was difficult. But what we've seen in the last few months is some of these supply constraints really have now largely been removed. So for the manufacturing base in Japan, they can actually ramp up capacity to full levels. And that's especially so for the auto manufacturers. Very quickly on this final slide, fund positioning for us. We are overweight financials, overweight autos, and overweight materials. We have a 40% discount in the stocks we own to the market price to book valuation. So Japan is cheap, but the stocks we own are even cheaper. And I'll come on to that point in a minute and elaborate on that. And then finally, we have 65% upside to our own valuation targets for the stocks we hold at the moment. So although Japan is up 25% year to date, we still have a lot of upside for the positions that we hold. So we're still quite excited about the future. I'm going to show you a couple of quick charts. Firstly, valuations. So price to book of Japan on the right-hand side in red is 1.5. That is up from 1.3 at the beginning of this year. So valuations have moved. But even though they've moved, it's still cheap compared to Europe on 1.9. And arguably, Europe has a stagflation and a growth problem and doesn't have the structural corporate reform tailwinds that Japan has. And the US is now on 4.3 times price to book. So very expensive. And most investors I speak to around the world, whether that's institutional clients in the US or family offices and private banks in Europe, they are starting to take profits in the US, reduce their overweight to the US, and actually redeploy that into some Asian markets, but also particularly Japan. And that's what we've seen year to date. Okay, so corporate governance. The prior speaker talked about the cash-rich nature of Japanese companies. So the chart on the left-hand side here shows that the topics, on average, a company in the topics has, 57.9% of companies in the topics have net cash on their balance sheets. That means they have resilience. So if we do have a global slowdown later this year or next year, there is a global recession. Japan is not going to be immune. Japanese companies are pretty resilient, so they can weather that storm. The more important reason why cash on the balance sheet is important is because with a little bit of pressure, corporate management teams can actually be pressurized to return some of that cash to shareholders through improved dividends and more share buybacks. And that's very important for equity investors like us on our desk, but also ultimately for you who own the fund and have exposure to Japan as too. So the opportunity for Japanese companies to return that cash to shareholders is pretty big. And you'll see that on the left-hand side here with dividends and share buybacks having gone up from a very low level in 2001 to a more reasonable level in 2023. And we expect that trend to continue. One of the key things in the corporate reform arena at the moment is the Tokyo Stock Exchange. They've announced an initiative back in February this year to challenge all companies that are cheap, they're trading on less than 1 times price to book, to improve their profitability. Now in Japan, if your company is on this list, you're effectively being shamed to improve your profitability, improve your ROE and your profit margins, and ultimately improve your returns to shareholders. And shame is a big motivator in Japan. People don't want to be publicly on this list. So corporate management teams over the next 12 to 24 months are going to be announcing more share buybacks, and they're going to be announcing more restructuring and looking at underlying profitability. Historically, that wasn't always important. As of today, it's very important for CEOs and CFOs to improve their underlying profitability. So that's a longer-term structural change. It's not fully appreciated by investors globally yet, and I think that's one of the main sort of drivers over the coming years. A result of all that is going to be better margins. This is profit margin as a percentage of sales. Back in the 90s, margins were wafer thin. As I said earlier on, Japanese companies were not good at allocating capital effectively, but they have improved. But at 6%, which is where margins are today, that's still below Europe and way behind the US. So as I said, we're on a journey. We're halfway through that journey probably. Japanese corporates can improve their underlying profitability. So if you're going to remember 2 things from my presentation today, remember that Japanese corporates are still reasonably cheap. And secondly, profitability of corporates is probably going to improve going forward from here. And from an equity investment perspective, we can complicate it by showing you 100 charts. But when it comes down to it, those 2 things are absolutely critical. And with more foreign buyers coming into the market, most of them are massively underweight, looking to increase their exposure to Japan. You should see a continued re-rating for the Japanese market over the next sort of 1 to 2 years. What happens in the next 3 months, I don't know. I think it would be healthy to have maybe a little bit of a pullback. But on a medium-term, a long-term view, the structural case for Japanese equities is very strong. Just cognizant of time a little bit, I'm going to rattle through a couple of extra slides. So wage growth in Japan has been anemic for so long. People haven't been given wage increases, and therefore psychologically they've not wanted to spend or invest. That changed early this year. We've seen wage growth of 3 to 5%. That's a step change from the last 20 years, and it's very, very important. With a little bit of wage growth, with a little bit of inflation, Japan has had the best chance in a generation to move to a more inflationary environment. So some people think inflation's bad in the US or bad in Europe. Well, if inflation's 10%, then yeah, that's not great. But in Japan, a little bit of inflation, 2-3%, it's a game changer. And you can move from that deflationary environment we've had for 20, 30 years into one which is a bit more self-fulfilling around growth with a little bit of inflation. The other chart is on tourism. Tourism had been built up over the 10 years prior to COVID to being quite a meaningful part of the economy. That obviously stopped during COVID. We've seen a bit of a rebound, but we haven't seen a full rebound. So expect tourism to continue to drive the economy in Japan, especially the Chinese tourists that I mentioned earlier on. The elephant in the room is yen, is the currency. What happens to the yen? At the moment, yen is 143 against the dollar. That's pretty weak. This chart shows 20 years of history. So the red line shows dollar yen. An average is around 110, 120. So at 143, it's pretty weak. So if you're looking to go on holiday, go to Japan. We all love Japan. It's a great place to visit, but at the moment with the currency, it's also quite cheap. What that means, though, from an investing point of view, is that manufacturers that export are actually pretty competitive globally, and that's quite important. What happens medium to long term? I do think there'll be a bit of mean reversion. If we do get slightly tighter monetary policy in Japan, which will happen at some point, you'll see the yen probably strengthen again against the dollar. But at the moment, it's at a very sort of extreme weak level, and you can exploit that. So that's more on the markets. It's reiterating some of the points from the prior speaker. Let me introduce you to sort of how we invest and the team, and I'll rattle through this quite quickly. So there's 4 stages to our investment process. We are a long-only Japanese equity manager. We hold typically 35 to 40 stocks. We're low turnover, typically around 25% a year, which means that if we buy into a stock, we hold it for 3, 4, 5 years. We're not short-term traders. We are very patient, long-term, contrarian investors. And that's quite important to have a robust process around what you do. The 4 stages, firstly, idea generation. We take 2,000 stocks in Japan into our screening process, and we look for those companies that have derated versus the market. So those that are 1 standard deviation cheap on price to book, price earnings, dividend yield, and price. So we're not looking necessarily for the cheapest companies, we're looking for those that have derated. And what we want to understand is where the market is getting the earnings wrong. It has a very pessimistic view, and in our view, that's incorrect. So if I see a company that's derated by 1 or 2 standard deviations, it has 10 sell-side analysts that all hate the stock, but in our view, on a 5-year perspective, earnings will recover, then that's a great investment idea for us. A good example is Kirin. Kirin is a beer manufacturer, a brewery in Japan. During COVID, the market sold off Kirin massively because of concerns around the fact they were not selling much beer through the pubs, through the bars, through the restaurants. But in our view, that wasn't going to carry on forever. So we exploited that, bought into Kirin, and then last year, as COVID sort of largely ebbed away and Japan reopened, Kirin breweries, the stock, re-rated very strongly. So we're looking for those periods of mispricing in the market that we can exploit as investors. We're trying to exploit that short-term pessimism that a lot of the market has. The second stage is fundamental analysis. Our fundamental analysis is bottom-up. It's very stock-driven. We spend 2 or 3 months building a model, talking to CEOs, talking to CFOs, talking to suppliers, other people in the industry, consultants, to really build up a deep valuation model on a stock. And we look for at least 60 to 70% upside before we invest in a company. In terms of portfolio construction, we typically take a 1% position initially, and as our conviction levels build, we'll increase that position up to 5 to 6%. And then the 4th part of the investment stage is risk control and review. We have a weekly team meeting where we talk about all the stocks in the portfolio, and we have a monthly risk meeting where we look at some of the top-down risks. The team, we're all based here in Singapore. We find that a slight advantage. We don't need to be based in Tokyo. Sometimes as an investment team, if you're based in the local market, you're subject to a lot of market rumors, a lot of market noise, and that isn't really what drives long-term valuation and long-term outperformance. So being based here in Singapore, we get plenty of corporate access, seeing CEOs and CFOs. We also travel to Japan a lot to meet the companies on the ground. But we're happy here. It's worked for us. We've delivered 2 to 3% outperformance a year over the last 16 or 17 years. So yeah, it works well for us. Avilo on the left, he graduated in Japan. He's a fluent Japanese speaker. He worked for Fidelity for 10 years before joining us. He leads the team. Max on the top left, same haircut as me. He runs our smaller company strategy. He lived in Japan for 15 years, married to a Japanese lady. His Japanese is amazing. His accent is incredible. Sam, he is Vietnamese, but he did an MBA in Japan. Charlotte studied in Japan and worked for Goldman's on the sales side there for a few years. So as a team, we're not Japanese nationals, but we have a really deep understanding of the culture and the drivers from a corporate perspective. And we have a dispassionate view of investing into companies. We're not subject to some of the local biases, which local management teams can be. In terms of performance for the fund, year to date, the fund, which is the Singapore dollar hedged share class, that is up nearly 15%. That's relative to the market, which is up 17%. So a slight underperformance. Most of that is due to the fact that year to date, a lot of the high growth technology companies, such as Advantest, have done very, very well. And we don't own much in that area because it's very expensive. We look for slightly cheaper companies, and we have a value tilt to how we invest. On a 1 and 3 year basis, the fund has delivered 23.7% on a 1 year and 24.2% on a 3 year basis. That's per annum. So returns have been phenomenally strong. Can that continue? I think the structural case is definitely intact, per my comments earlier on. Will it carry on at 20, 25% a year? Probably not. Experience would suggest that's very difficult to sustain. But I do think Japan's very well placed, and we can continue to see strong double-digit returns going forward. In terms of the positioning, as I said, the table on the right-hand side here shows our sector positioning. We're overweight autos because they're restructuring their businesses, and that is not priced into the market currently. Financials, we have a small overweight. As we move from a deflation to an inflationary environment, a lot of the banks and financial companies are going to benefit from that. And domestic companies, supermarket chains, retailers, we have an overweight there as well. They are laggards in the market, and we think there's a huge valuation opportunity there as Japan reopens. In terms of the stocks, you'll see our top 10 on the left-hand side. Some of these names you're going to recognize: Panasonic, Honda, NEC maybe, and some of them you won't recognize. If you get on a train in Tokyo, you're probably going to use East Japan Railway Company. They're benefiting from a reopening. Things like Daito Trust is a small mid-cap name that builds properties and leases them out. Again, it's benefiting from the fact that Japan is now moving from a deflationary to an inflationary environment and is reopening after COVID. So I'm just going to finish on one final slide. Go back. So just to sum up the opportunity, I think the Japan investment case is very, very solid. There's lots of opportunities. We still see valuation upside in Japan. We have a very robust process, very repeatable. It's been stress tested over 17 years through bull markets and bear markets, and we deliver 2 to 3% alpha through a cycle. And that's important for potential investors. We're looking for those outliers. We are contrarian. We are value investors. And we have a very experienced team. The sales guys in my team have said that we have both Singapore dollar and US dollar hedge share classes available. So if you're interested in Japan, you're interested in our fund, please speak to me or one of my colleagues outside. And I'm going to end it there. If you have any questions, please come and see me. I'm very happy to help you. Thank you.
Good morning to all. Hope the sessions so far have been great. I know today this is not an Army or Jackie Chan's concert, but I think we do hope you all will have an equally good time at the end of the day when you leave. Okay, let me not waste any more time. So for today, I'm going to do a very quick review on the bonds market in Singapore corporate bonds for the first half of 2023, followed by an outlook coming in for second half of 2023. Lastly, I'll close out on some suitable bond recommendations on bonds based on the current economic environment. First up, for the majority here when it comes to fixed income, I think the first thing that will probably come to your mind is the Singapore Treasury bills. As the interest rates rose significantly in 2022, the popularity of T-bills undeniably grew at the same time. You've probably seen so much of it coming out of media, Straits Times, Business Times. So actually for T-bills, we have been seeing the yields, seeing a divergence in the direction as compared to the Fed funds rate in the US, which, as we know, we just recently saw the Federal Reserve taking a pause on the rate hikes in June. As you may observe from the graph, despite the rate hikes happening in 2023, after the T-bills have hit their peak in late 2022, yields on the Singapore T-bills have gradually been coming down to this current range of between 3.8 to 4.0% in 2023. And this is happening despite the yields on the US Treasury. They are still continuing to rise, especially across April and May, where you guys probably would have realized, because of particularly more rate hikes, banking crisis, and also the ongoing US debt crisis, US debt ceiling crisis at that point of time. Ultimately, the situation isn't also surprising, which is simply due to the stable monetary environment we have in Singapore. If anything, the banking crisis probably highlighted the strength and the stability of Singapore's monetary environment even more so. And of course, this stable monetary environment is likely because of the underlying reason for this rapidly changing sentiments when we see the interest rates for the yields on T-bills, contributing to this drop that we see today. Okay. On the other hand, looking at the issuances in the Singapore corporate bonds market, it is mostly caught in between. Observed in the graph on the left-hand side, issuance had fallen off from the highs as we have seen in the previous 2 years, 2021, 2022, coming to a level closer to the pandemic in 2020. And even for the issuances in 2023, we did observe a huge proportion of them coming from financial sector, this increasing quite significantly. Issuances coming out from non-financials, reflected by the light blue color part, had fallen off quite significantly as well. From the graph on the right, you can probably see such a trend reflecting in the same through the issuances by geographical regions. For issuances, the majority of the financial sector issuances, they are coming up from the foreign regional banks, especially coming from Europe. On the other hand, borrowing is difficult for the corporates in Singapore, given the sky-high interest rates environment we are seeing today. Most corporates are likely considering to obtain short-term temporary loans from banks to tide through this high interest rate period, rather than having to issue loans or issue debt that will require them to pay more in the longer term. Coming to the outlook for second half, we actually believe that the interest rates are likely to start stabilizing from here. In the previous 2 rate hike cycles, right, historically, we have seen the use on the Singapore government securities, looking at 1 year and 10 year, falling off and reaching a plateau before the US Fed funds come to a rate pause. So in the both periods between 2026 to 2028 and also 2018 to 2020, we can see the yields either tend to fall as the Federal Reserve begins on a rate pause, or to stabilize and hold even before a rate pause in the United States begin. Okay. In the current cycle, I think we have already seen such a trend happening, especially with the US Federal Reserve recently suggesting a possible rate pause in the previous meeting in June, although in July we might see something else happening. Although the yields did spike up right before the start of the banking crisis, and also quite recently because of the uncertainty in the US debt ceiling, we think that these are one-off events instead of having a longer-term impact on the yields. As a result, we do feel that the interest rates in Singapore are likely going to further stabilize from here, or even possibly taper off gradually, especially on this current backdrop, pending rate pause from the Federal Reserve moving forward. And of course, a question that usually comes up when we are looking at short-term yields on T-bills and also the long-term yields on the Singapore government bonds is that, is it possible for us to see the yields to break past the peak that we have seen before? If you look into the past data, we can observe similar movement trend between the inflation in US and also our 10-year Singapore government securities. The rise in the Fed funds rate and therefore interest rates was undeniably due to the high inflation that was happening across the globe in 2022. For Singapore, our situation is quite unique in the sense that the Monetary Authority of Singapore, MAS, our government body for money, it actually manages our monetary policy through currency exchange rather than through interest rate that is more commonly seen in other countries. So as a result, we are mostly an interest rate taker, where our interest rate environment is mainly determined by external factors. For us to look at yields higher than previously, while we do believe that inflation is potentially staying higher for longer, we will need inflation to spike up levels beyond the peak, which means that inflation in the US needs to spike back up to more than 9% for that to happen. In the current environment, while we still do see inflation in the US above the Federal Reserve target of 2%, we do think that the monetary policy in place has been taking effect thus far. As such, given the current outlook for the next half of 2023, we don't think this situation is likely, which means inflation breaking past the peak. Now, with lesser expectations for the interest rates to rise moving ahead, it is likely going to be a good time for the Singapore corporates to actually start raising funds through the issuance of debt again. The environment should make it much easier for them to consider the issuance of debt, especially after a very difficult first half of the year where they had to take a long hiatus and the rates continue to be historical high. Moving ahead into the second half of 2023, we do think that more corporate issuances are likely going to come out from different issuers, especially not just coming out from financials. So investors like yourself are going to have more opportunities to choose from. Given the current economic outlook, we still do prefer investment-grade issuers, especially with the possibility of recession increasing every moment. On the other hand, investors may want to look at adding duration to their portfolio, especially as we see the yield curve potentially coming flat with the stabilization of the longer-term yields. While we do expect more insurances coming out in the second half of 2023, it doesn't mean that there are no good options for now. So here we have shortlisted some of the bond options for your consideration. First up, we have OUE. I believe OUE is quite a known brand in Singapore, particularly with assets like OUE Downtown, OUE Bayfront, and they also manage the Hilton Orchard Singapore, which is the flagship Hilton brand across Asia Pacific. OUE has been moving past just real estate in the recent period, which it has endeavored into a variety of sectors: commercial, hospitality, retail, residential, and also healthcare. At the same time, OUE is also the manager of two REITs in Singapore. We have OUE Commercial REIT and also First REIT. The total management asset under management is at 9.5 billion of assets under across the whole of Asia, which the two REITs actually account for 7.8 billion of it. For the financial year ended 31st December or 31st December 2022, or just call it fiscal year 2022 for short, the real estate segment continues to be the main driver for its business, bringing in about 68% of the group's turnover, which is coming mainly from collectively under investment properties, hospitality, and also real estate development. For OUE, we believe the relaxation in the COVID-19 restrictions have been beneficial for its operations. In fiscal year FY 2022, we see a substantial rise in the profit at 347 million as compared to SGD 101 million in 2021, which had been a very good recovery, especially if we consider in 2020, they had suffered 405 million worth of losses due to COVID-19. Overall, we are particularly optimistic in two segments: hospitality and healthcare. In the current trend of the global tourism recovery and growth, much of it is due to the recovery from the effects of COVID-19 pandemic. We believe that the turnover coming from hospitality is likely going to rise and grow further, especially with this year, we see a full reopening of Hilton Orchard Singapore. For its healthcare segment, we like the diversification into the healthcare business, which should provide for additional stability for OUE, especially given the current environment whereby property development is especially temporarily hindered by the high interest rates. Coming to its credit profile, it remains generally decent with some limitations utilizing their cash, as their cash position is unlikely to fully cover for their short-term borrowings, but it is also likely for them to rely on further borrowings for them to refinance their ongoing debts. On the very bright side, we feel that OUE is unlikely to face problems getting additional loans, especially with further room ahead for them to tap on secured borrowings. Overall, its credit profile is likely to stay decent in the shorter term, especially with hospitality expected to provide to continue outperforming in these recent years to provide that much needed cash flow. Across the fixed rate issuances we have by OUE and its related entities, we have a preference for OUE 3.5% given the higher yield to maturity at the maturity periods left. Given a relatively small issuances size of SGD 200 million, OU is unlikely to face any issues trying to refinance or to reissue a new debt for this. In addition, with the maturity date in 2026, there is ample time for the policy rates to actually settle down and to stabilize. With US Federal Reserve, recently in June, they just paused the rate hike. We believe that OUE is likely going to be able to refinance at a lower cost given the current improvements we are seeing to its credit profile as it recovers from the COVID-19 pandemic. In this post-COVID era, we believe OUE has much further room for improvement, especially in an environment of recovering tourism. We are optimistic about its outlook in the upcoming years, but we also see a need for OUE to manage its capital more carefully in this high interest rates environment. In our view, this 3.5% OE3 SP 3.5% will be optimal for investors looking for options in the short to medium term. Next issue we would like to highlight is ESR Group. For those who might be new to ESR, just a brief introduction. It is currently the APAC's largest real estate manager and also the third largest listed real estate investment manager globally. It taps into major APAC markets, including China, Japan, South Korea, Australia, Singapore, India, and New Zealand. At the same time, it's also the largest sponsor and manager of REITs in APAC with a total AUM of USD 46 billion. Following the acquisition of ARA Asset Management, the combined ESR Group saw revenue growing by 128% to USD 821 million in FY 2022. Total AUM grew to USD 156 billion for 2022, and due to the higher AUM, management fee revenue increased by almost threefold to USD 713 million from the acquisition of ARA and also organic AUM growth. ESR experienced this strong growth due to continued demand for new economic properties, which this includes logistics, e-commerce, and data centers, properties which are deemed to be in a high growth stage. E-commerce and third-party logistics makes up 76% of the new leases they have signed in 2022. Based on McKinsey & Company, e-commerce in Southeast Asia is expected to grow at a CAGR of 22% from 2022 to 2026, while Prekin estimates that data centers will grow at a CAGR of 32% from 2022 to 2025 in Asia. Looking forward, we think that ASR is very well positioned in APAC for future growth as new economy segments will continue to thrive from this strong demand. In order to capture the high demand for logistics spaces, ESR has been expanding its developments. Due to low vacancy rates in its properties, ESR has been expanding its portfolio rapidly by developing new logistics and new economic properties. ESR maintains a very sound credit profile currently following the acquisition of ARA. In FY 2022, ESR had cash and cash equivalent of USD 1.8 billion, which is sufficient to cover its short-term borrowings of about 290.5 million. Gearing for the company is also relatively adequate, which is at 22.8%. One thing to note is actually the group's proportion of fixed rate borrowings. It currently stands at 15% for fixed rates, while 85% are on floating basis. Given a high interest rate environment, the group is likely to incur a higher interest cost. But we also do know that the weighted average interest rate is currently still manageable at 4.2%, while at the same time, its interest coverage paying ability, interest coverage ratio is still extremely strong at 4.8 times. This year, or rather last year, ESR Group actually has managed to achieve an investment grade rating of AA- from the Japan credit rating agency. It is rated top among the offshore real estate companies rated by JCR, the rating agency. And this will actually allow ESR to lower its interest costs and also potentially increase its tenor from the future yen-dominated borrowings it might get. Coming to the recommendations offerings, we have ESRK's 5.65% perpetual and also ESRK 5.1% bullet on our Bond Express platform, more than just on our platform itself. So these two are available on our Bond Express, which is one of our unique offerings for clients who are looking to find bite-sized bond issuances. This is exclusively available for accredited investors. We like the perp because of a low non-core risk, which has a high initial spread and also a step-up margin of 200 basis points. At the same time, for the bullet of 5.0%, it is 5.0% due to maturity. It is quite hard to find issuances among the market, especially in the SGD space with such a relatively good credit rating. Overall, we find the growth prospects of ESR to be attractive, especially within this new economy segment that they are capitalizing on. The demand-supply imbalances for logistic properties will continue to fuel rental growth, and the large development workbook of ESR will provide new properties for ESR to actually channel into their various funds that they manage. The lack of supply will also ensure tenant stability in the longer run, and also a growing e-commerce space will continue to fuel the demand for logistics spaces. That concludes the end of the 2 recommendations we have, and hopefully in the second half of 2023 for even much more options for you all to consider. Make sure to follow us on our social media for the newest updates on our bond research and newest issuances. Thank you so much.
Thanks very much. Thanks everyone for being with us here today. So I'm Hilda from Schroders, Asian Fixed Income Product Manager. So today, as you can see up here on the screen, the title of my presentation is Asian Credit, Giving Credit Where Credit is Due. Now, we thought this topic would perhaps be interesting or relevant to many of you here because Asian credit is an asset class that's often overlooked or underallocated to, but also an asset class which we believe deserves a lot more attention than it currently already gets. So today, in my presentation, I aim to answer 3 key questions for you. Why Asian credit? Why Asian credit now? And why Asian credit via Schroders? But before we begin, what is Asian credit? So when we talk about Asian credit, we are really referring to US dollar-denominated bonds issued by issuers from within the Asia region itself. But of course, for many of you here who might be Sing-based or Sing dollar bond-based investors, typically for Asian credit mutual funds, we also have Sing-hedged share classes, so you are not exposed to the currency volatility involved from the USD to the SGD. So to begin with, why Asian credit? Now, we thought it would be helpful to first start with a market overview and also understand some of the key merits that this asset class brings. So here you can see that the Asian credit market has grown exponentially over the past couple of decades to reach more than $1 trillion in terms of market value right now. So this actually puts it pretty close in size compared to the US high yield market, definitely an asset class that is growing and increasingly too large to ignore. Now, an important feature of this asset class that's worth highlighting is that the Asian credit market is fundamentally a very high quality one. So if you're to see here, based on the breakdown between the green and the blue color, so the green color actually represents the investment grade segment of the entire Asian credit market. Now, as we know, the investment grade issuers refer to companies which are typically a lot more stable because they also have stronger credit profiles. And right now, the investment grade segment takes up more than 85% of the entire market. And this actually brings the overall credit rating of the whole market to a very high rating of about A- as we speak. And this actually puts it much higher in terms of credit quality compared to many other emerging market fixed income asset classes, for example, in Latin America or in CEMEA, where on average they are rated BB+, and that puts them in the high yield category. Now, not only is the market a very large one, it is also a highly diverse and dynamic one, really allowing investors to assess very varied opportunities all within one market itself. So here on the left-hand side, you can see the breakdown of the market from a geographical point of view. And clearly, China takes up a very huge percentage of the market at about 40% right now. And this is also why we often advocate for a more active management approach, essentially via mutual funds, as opposed to passive via ETFs within the Asian credit market, really to avoid concentration risks within a particular market. But of course, on top of China, we do see quite a nice representation of many different economies. And that is to say that when investors invest within the Asian credit market itself, they do get access to issuers that are exposed to very different factors, depending on the economic, political, and regulatory landscape in which they're based in. Now, on the right-hand side, similarly, from a sectorial point of view, you can see a very wide range of sectors being represented in the Asian credit market. And this actually makes the Asian credit market a lot more diverse and dynamic as compared to the US fixed income market, which many of you might be invested in, because the US fixed income market is made up majority of US sovereigns, or as we know it, US treasuries. So here, to put things into context, I'll give you some examples. So within financials, you will have US dollar-denominated bonds from the likes of DBS, OCBC, UOB, Bank of China. So names that you perhaps are very familiar with. And what makes Asian credit quite unique as compared to Asian equities would be that we also have sovereign representation, and essentially these are US dollar denominated bonds issued by Asian governments, with majority coming from Indonesia and also Philippines. TMTs, we have US dollar denominated bonds from the likes of Alibaba and also Tencent. So not just names that you're familiar with, but perhaps even names in which you are even users or customers of. Now here I wanted to introduce a phenomenon within the Asian credit market that makes it pretty unique compared to other emerging market fixed income. And that is the Asian bid. So when we talk about the Asian bid, essentially it refers to the trend of in-region Asian investors forming the majority of investors within the Asian credit market itself. So here you see the breakdown in terms of issuer base on a historical basis within the Asian credit market. Asian issuers being the ones in blue. And quite clearly, over the years, Asian issuers have taken up an increasing proportion of the entire investor base at about 76% as of Q1 2023. Now, this is much higher compared to many other emerging market fixed income. For example, within Latin American credit, LATAM credit is majority taken up by US-based investors at about 58%, and only a mere 5% is taken up by in-region Latin American investors themselves. And the fact that we have an Asian bid is definitely very supportive and helps to anchor the entire credit market over the longer term. Because if you think about it, during times of market stresses or significant market volatility, investors that are based within the region are less likely to withdraw their money very quickly or at large amounts, because being based here, they tend to be more familiar and also comfortable with the names in which they're invested in. And over the longer term, this has actually gone a long way towards lowering the volatility of the entire asset class, something which you'll see in a few slides later. Now, from a valuation standpoint, Asian credit is attractive. So here we actually show the corporate spreads across different regions on a historical basis. And quite evidently, Asian credit, which is in black, has actually offered a spread premium or a spread pickup compared to other developed market fixed income, including the US and Europe. So to be more specific, within the investment grade space, Asian investment grade credit offers a 60 basis point spread pickup as compared to US investment grade at the same average rating of about A-. On the high yield side, Asian high yield offers about 440 basis points of spread pickup as compared to US high yield, but at a higher average credit rating of BB- as compared to US high yield, which is on average rated single B+. So from a spread versus credit risk kind of perspective, I would say Asia credit offers a lot more value to investors. Now let's take a look at risk. So on the right-hand side, you can see the volatility of the asset classes across different regions on a historical basis. And evidently, Asian credit or Asian investment grade credit has historically offered lower or the lowest volatility as compared to many other fixed income regions. And you would recall that earlier on I mentioned that the investment grade segment actually takes up a huge majority of the entire Asian credit market. So this is to say that the Asian investment grade segment really helps to anchor and stabilize the entire asset class, giving a lower volatility kind of experience for investors within the Asian credit space. So with lower historical volatility and also higher returns, it's perhaps not surprising that Asian investment grade credit has offered a much stronger Sharpe ratio, or essentially risk-adjusted returns, as compared to other regions on a historical basis. Now, by now, I've spoken about many different concepts, and you might be wondering, so how should investors be looking to use Asian credit within their portfolios? I think an important point to highlight is that we're not saying that you should therefore allocate your entire portfolio all into Asian credit itself. Rather, what we're saying is that by adding Asian investment grade credit or Asian credit into your portfolios, you can potentially diversify or benefit from the diversification potential of the asset class itself. So on the left-hand side, this table actually shows the correlation of Asian investment grade credit compared to other high-quality asset classes across different regions. And clearly, Asian investment grade credit has very low correlations on a historical basis compared to many of these regions. And this also means that by adding Asian IG into your portfolios, you can potentially optimize or enhance your portfolios from a risk-adjusted return point of view. On the right-hand side, this is exactly what we see from an efficient frontier standpoint. So here we actually build out an efficient frontier using several asset classes which are perhaps quite common in your portfolios. The green dot on the left-hand side, on the right-hand side, being a very typical 60-40 global equity versus fixed income kind of portfolio. So as you can see, if we were to add Asian investment grade into your portfolios, it can potentially push the portfolio out further up into a more effective or attractive region. And this essentially means by adding Asian investment grade credit to your portfolios, you can potentially maximize or optimize your portfolios and make it a lot more efficient than it might already be. So I've spoken quite a bit about the entire market itself and also some of the key merits that it brings. And at this point, I wanted to share a few reasons as to why you should be looking at Asian credit based on the current market environment that we are in. It's perhaps useful to first start with an overall macro backdrop in which we are operating in. So as you would know, this year we've heard many concerns about a potential global recession or global growth slowdown. And I think against this backdrop, Asia as a region actually stands out very much as a bright spot because the region is positioned very strongly relative to the global economic cycle. On the right-hand side, APAC is expected to contribute about 70% of global growth this year, definitely a key driver of growth for the world. If we were to break this down in terms of growth or expected growth across different regions, on the left-hand side, you would see the IMF forecast of growth across different regions this year compared to 2022. On the far left, you can see that the world is expected to grow slower this year at about 2.8% as compared to last year. And this is also a similar trend which we see for different developed markets or emerging market economies, including US, Europe, Latin America, and also Middle East. But on the contrary, Asia, which is boxed up in orange on the right-hand side, is expected to deliver stronger growth this year at about 5.3% as compared to 2022. And this is not just driven by the whole China reopening story and therefore China's growth, it's also driven by very firm economic outlooks from major economies in Asia, including India and also Indonesia. So Asia as a region definitely represents an investment universe with ample opportunities for credit selection in 2023. Now let's take a look at fundamentals. So fundamentals within Asian credit or Asian corporate issuers has been very resilient, particularly within the investment grade segment. So whether we look at leverage ratios or liquidity ratios, overall credit fundamentals have been strong or credit profiles have been strong for investment grade corporate issuers since last year and also this year, and in fact improving at several segments within the IG space. And already we have started to see these stronger fundamentals being fed into the rating actions that we've seen. As you can see on the top, for the investment grade issuers, we have seen an upward momentum, which essentially means that we've seen more upgrades in terms of rating actions as compared to downgrades within the investment grade space. And overall, this actually positions these issuers very well against an overall backdrop of a potential global growth slowdown and also tighter credit conditions as well. So from a valuation standpoint, we all know that the global credit markets have actually experienced massive repricing over the past couple of years. But because of that, it has actually led to very attractive valuations within the Asian credit space. So here we actually show the average prices in Asian investment grade and also high yield on a historical basis. And clearly, where prices are trading at right now, it represents a huge discount compared to longer term averages. And the last time we've seen such attractive valuations was back in 2008 and 2009 during the global financial crisis. And it's also pretty evident how strong the rally or recovery was thereafter. So right now in the investment grade space, it's trading at about 12% discount compared to long-term averages and about 30% discount within the high yield space compared to long-term averages. Now, as we know, bonds tend to pull to par, so assuming there are no defaults within your portfolio and you got your credit selection right, this actually represents an extremely attractive entry points for investors within the Asian credit market. Of course, it's not to say that you should therefore allocate your money all into Asian high yield just because it's trading at a larger discount. We have to remember that the high yield segment inherently incorporates a lot more credit risks and is therefore only suitable for investors who have a stronger risk appetite and can stomach the volatility that investing in the high yield segment brings. Now, looking at it from a slightly different perspective, from a yield point of view, the yield landscape has also transformed dramatically over the past 2 years. But this allows fixed income to once again offer the income that investors are looking for when investing in this asset class. So here we chart out the historical yields across investment grade and also high yield. And clearly, where yields are trading at right now, it's much more attractive compared to just 2 years back. So to be specific, within the Asian investment grade space, it currently offers about 6% of yield on average, and this is much higher than the longer term averages of about 4%. In fact, the highest that it's been in 14 years. So this is to say that Asian or investors now can actually build a very high quality portfolio all within Asian investment grade or the Asian investment grade segment, and thereby allowing the Asian investment grade segment to once again offer very attractive income generating opportunities which are relatively more stable. And at this point, you might be wondering, how does Asian yields stand compared to other regions in the fixed income space? Here we have it charted out from a yield versus duration point of view. So as we know, duration measures the interest rate sensitivity of the asset class, and effectively it's also a measure of risk. So it's therefore a lot more attractive to be positioned on the top left corner of each chart. And here we actually have two sets of data. So the ones in dark blue, or the points in dark blue, represent the points which these asset classes were in December 2021. And the green one being the points they are at right now. And quite clearly, if we were to compare the blue versus the green, I think the trend is pretty obvious, whereby fixed income asset classes can now or offer a lot more attractive yields to investors. But if we were to compare between the green dots or across different regions, evidently Asian credit is positioned a lot more attractively from a risk-adjusted yield standpoint. Or to put it simply, giving you a lot more bang for your buck right now within Asian credit. So I've spoken at length about the Asian credit market, and at this point, I wanted to spend some time to introduce our Schroders Asian credit platform and also capabilities. Here you see some of the key highlights of our Asian fixed income platform. Now, as you know, Schroders has operations globally, so we do have investment professionals based across different regions across the globe, all dedicated towards their respective asset classes and also expertise. And in Schroders, we have aligned our credit platform globally. So that is to say that our Asian credit team, that's based within Asia itself, has seamless and very regular access to our entire global platform's resources and also expertise as well. Of course, this is very important because, as you know, Asia doesn't operate as a silo and is definitely impacted by developments across the globe. Importantly, within Asia, Schroders boasts one of the best resourced Asian fixed income platforms with more than 30 investment professionals dedicated towards Asian fixed income, and they are based across different markets in Asia itself. For example, Singapore, Hong Kong, Shanghai, Indonesia, etc. And I think something that's really powerful or gives us an edge compared to many other houses is that within Asian fixed income, we actually have expertise across the full range of Asian fixed income capabilities, including Asian rates, Asian currencies, and of course, Asian credit as well. So although the Asian credit team are the ones who manage our Asian credit portfolios, the fact that we have an Asian rates team and also an Asian credit team within Singapore is something that's really powerful because the interaction between both teams really helps our Asian credit team to develop a more multifaceted view of the entire Asian credit universe and also the issuers within. We've been invested in this space for a long time, in fact, since 1998. And I think considering the fact that the Asian credit market is a relatively young one, this also means that right at the very beginning, when the market has first started to grow or develop, we have already been in this space, invested in this space, and also analyzing the issuers within. And over the longer term, we have delivered also a very strong and successful track record in Asian fixed income. Over the years, as our team and also platform has grown, so has the AUM that we manage. So as we speak, we manage more than 11 billion worth of AUM, all dedicated towards Asian fixed income strategies. Definitely a very trusted investment partner within the Asian credit space. So zooming into our Asian fixed income platform, here's how we are set up within Asia itself. So on the left-hand side, as I mentioned earlier, in blue, we have our Asian macro team. So that covers our Asian rates and currencies capabilities. On the right-hand side in green, we have our Asian credit team. And essentially, they are the people who manage our Asian credit portfolios. And quite evidently, you can see that we have a very well-resourced and robust platform. So on average, we have about 14 years of investment experience within Asian fixed income across all the professionals that we have. Focused on Asian credit, in green, we have our Asian credit fund management team and also our Asian credit research team.
So both teams actually work very, very closely together. In fact, they speak with each other multiple times a day, really to analyze and understand the issuers in which we invest in, and for trade idea generation, and of course, credit selection. As you can also see, the credit team is very aligned or well embedded within our global credit platform. So this overall really allows us to benefit from the beauty of having a robust global platform and also on-the-ground in-depth expertise. And that's all I have to share today. Here I summarize the key points that we highlighted in my presentation, hopefully answering the 3 key questions which I set out to answer: why Asian credit, why Asian credit now, and why Asian credit via Schroders. So I'll leave this here with you to have a look. Thank you very much for listening to my presentation. I hope you found it helpful. Thank you.
Good morning, ladies and gentlemen. I trust that you've had a very insightful morning so far, and thank you, iFAST, for having me. My name is Joanne Chia, and I'm a Senior Portfolio Manager with Nikkei Asset Management. Just to share with you a little bit about my firm, Nikkei Asset Management is one of the largest asset managers in Asia, with assets under management of over 200 billion. So our head office is in Japan, Tokyo, and we have presence in 11 countries worldwide. For our Singapore office, we acquired DBS Asset Management back in 2011. And so the Singapore office is the largest center of excellence outside of Asia. Now, as we enter the second half of 2023, I think it's a great time for all of us to be taking stock of our investments. And so I'm very excited to be here today to be sharing with you why I think 2023 is a year for Asia fixed income to shine. Now, earlier outside the booth, I've had a chance to chat with some of you. And in my conversations with my clients, here are the 3 key investing questions for 2023. Will interest rates continue to rise? Is a recession coming? And of course, how should I invest my money? Now, in fact, all the 3 questions are interlinked. And today, our aim is to get a good sense of what to expect going forward and to understand why Asia fixed income is a space to be invested in. So in the comic here, you can see that the Fed, which is the US central bank, is trying to hit the inflation target but keeps missing. So what's going on here? If we take a step back and think about how we got here. Back in 2020, we had COVID. And then businesses had to shut down, factories had to close. And central banks globally had to cut interest rates to try to stimulate the economy, try to make borrowing cheaper. But then these closures also meant that when the economy started to reopen the following year, there was not enough production inputs to produce goods. And so this led to a rise in production costs and essentially a rise in selling prices. So we get inflation as a result. So this led to higher food, higher electricity, and higher prices of coffee. That's why we all come here early for kopi this morning, right? So anyway, with higher prices, central banks had to reverse the action and raise interest rates to try to bring inflation down. And so since the start of last year, the Fed has raised interest rates by 5% or 500 basis points to try to target inflation. So I think where we are now, 2023 is definitely a year for Asia fixed income because I think Asia fixed income is a very attractive class for us to be invested in. So the first question we'll be asking is, why now? First of all, with interest rates hikes, this brings lower inflation and also slower growth. And that's what we have already been seeing even here in Singapore. So it's safe to say that the rate hikes are soon coming to an end. And secondly, with higher interest rates, there are winners and there are losers. So the losers will be those who borrow money. For example, like us who pay mortgage, our mortgage cost is getting higher. But with higher interest rates, the investors tend to benefit because by investing in bonds now, the yields are more attractive. So Asia credit yields are more attractive right now. And also towards the end of the rate hike cycle, the US dollar tends to weaken. And that is when Asian countries and currencies, in fact, would stand to benefit. So I'll be talking about these 3 points in my subsequent slides. Okay, first of all, you can see that with the rate hikes on top, the inflation has in fact come down. However, this inflation rate is still above the Fed funds target. So the Fed probably has to continue to hike about 1 or 2 more times. And if you look at the chart below, the yellow part shows the increase in the Fed funds rate. And this is the rate that the US Central Bank controls. However, long-term interest rates, which is the blue line on the bottom chart, the 10-year yield shows that it has been pretty stable over the past few months, even as the Fed funds rate continues to increase. And why is that so? Basically, long-term interest rates like the 10-year yield reflects outlook of the economy. So with slower inflation and slower growth, yields are likely to come down. And this is also seen in the Singapore savings bonds average yield. As we know, last year, the average yield at end of December was about 3.57%. And the latest cutoff for July this year was barely 2.82% on average. So in fact, long-term yields has in fact already started to show signs of stabilization. Now on the next slide, we shows that Asia credit is attractive. On the top chart, you can see that the average yield is about 5.6 to 6% currently. And this is above the mean of 4.1%. And just 2 years ago, the average Asia investment grade yield was barely 2+%. So right now is really a great time for investors to take advantage of this and lock in yields and potentially enjoy capital appreciation when the rate hike cycle turns. Now below, it shows that Asia credit, which is the Asia investment grade credit, which is the dark blue line on top, has a more attractive spread compared to developed market peers in the US and the Europe. So this slide shows that on a historical basis and on a relative value basis, Asia credit is in fact very attractive. Now, besides Asia credit bonds, we also like Asia local currency. And this refers to government bonds that are denominated in peso, rupiah, rupee, and other Asian currencies. On the top chart, you can see that emerging market Asia offers positive real 10-year yields. And these real 10-year yields refer to the 10-year local government bond yields of each country minus the inflation in that country. So that shows the real return that investors are getting. And this is positive compared to developed markets such as Japan, US, and Europe, where the real yields are negative, either due to higher inflation or lower yields to begin with. And besides offering positive real yields, Asia is really backed by strong fundamentals. As you can see in the lower chart, the IMF forecast for 2023 growth for China, India, and ASEAN 5 is about 4 to 6% for this year. And this compares with barely 1 to 1.5% in developed markets. So the positive real yields are backed by strong fundamentals, and therefore Asia local currency bonds are very attractive. So I've shared about why we are positive on Asia fixed income as a whole. But I do understand that as individual investors, it is difficult for you to construct your own portfolio and think about country, sector, currency allocation. So let us do this for you. Let Shenton Income do this for you. Now you see on this chart, investors are seeking stable returns amidst market volatility. According to the United Nations predictions, 1 in 4 people in Asia Pacific will be over the age of 60 by the year 2050. And this is triple the number since 2010. So this Straits Times graphic shows that investors have been turning to fixed income funds to look for to preserve their retirement income. And Shenton Income Fund is a dividend-paying fund that provides stability in the midst of market volatility. So here are the 3 key highlights of Shenton Income Fund. First of all, we provide regular income through monthly dividend payments. Secondly, we are absolute return focused, meaning to say we are unconstrained, we don't have to follow a particular benchmark. And this enables the fund to capture opportunities through credit, currency, as well as rates. And most importantly, we have a proven track record of delivering stable returns through market cycles. Now, this is a snapshot of the building blocks of Shenton Income Fund. Being absolute return in nature, we have the flexibility to get alpha opportunities through 3 engines: credit, currencies, and duration. So we invest in Asia credit, about 55 to 70% of allocation, as well as Asia local currency, about 30 to 45%. For the Asia credit portion on the left, this mainly consists of US dollar and Sing dollar bonds, and we invest both in investment grade as well as high yield. For Asia local currency, we take active FX positioning with the Singapore dollar investor in mind. And in terms of investments, we buy both our Nikkei AM local currency funds for diversification, as well as directly through bonds. And active duration management is taken on the portfolio as a whole. So this is done as an overlay. We manage the portfolio interest rates on an overall basis. And so the fund aims to achieve a 4% annual return over the medium to long term, and we pay monthly dividends. Okay, Shenton Income Fund has had a long history, and our focus is on delivering stable returns in all market conditions. The fund itself was established in 1989 and has been through many financial crises and global market cycles. As you can see on the chart, the shaded areas shows times of crisis. And we went through the global financial crisis in 2008, the European debt crisis in 2011 to 2012. We went through COVID and several rounds of rate hike cycles. And what you can see is even though the fund showed a dip, the fund eventually bounced back and emerged even stronger thereafter. So I think now is a great time to be buying into the fund to participate in the upside when the rate cycle turns. So in terms of return, we have achieved over 260% on a cumulative basis, 3.65% on a historical basis, and year to date, we are up by 2.7% as of the end of June. So this slide gives you a sense of how we managed the fund navigating a very tough 2022. You know, just like in a game of soccer, the end goal is the same, to score goals, to win the game. But there are times that you have to play defense when your opponent is attacking, and there are times when you go all out to attack. So this is similar to how we managed the portfolio back in 2022. Most of the 2022 was a tough period. We had interest rate hikes, so it was a more defensive period. And in 2023, we started to take more action and be more active with the portfolio to get returns. So just to give you a sense of what we did, in the first quarter of 2022, playing defense, if you recall, the Chinese property market was in crisis after the default of the largest developer, Evergrande. So the fund then actively reduced our Chinese property exposure. In the second quarter, we had the Russia-Ukraine war, which increased the inflation even further due to higher food and energy prices. And that is also when the US Fed started to hike rates. So we reduced the portfolio duration to reduce the sensitivity of the portfolio to interest rates. In the third quarter, China remained in lockdown due to their zero COVID policy. And so we reduce our China exposure and property exposure eventually to zero. Now, in the fourth quarter of last year, we turned slightly more positive because we saw signs that inflation started to ease and global growth was going to slow down. So we increased the duration of our portfolio and we increased our exposure to investment-grade bonds because we think that investment-grade will be more resilient to a slowdown as compared to high-yield bonds. And into 2023, as I mentioned earlier, we think that the US dollar strength would start to fade, and so we're more positive on Asia local currency, and therefore we increase our exposure to Asia local currency. So just to sum up, this really shows how we navigate the portfolio in protecting the downside as well as participating the upside. Now, I'll just round up my presentation with some of the highlights of Shenton Income Fund. And this is the fund that I manage. Okay, I know the words are a bit small here, but the average yield of the portfolio is about 5.2%. The average duration is about 5.7 years. And the average credit quality is BBB+, which is investment grade. In terms of the top holdings, the first would be in our underlying Asia local currency funds that consist about 35%, and the rest are individual bonds. Now, in terms of sector allocation, after funds, we have banks and REITs, and these are strong names that we hold in our portfolio. In terms of country allocation, the largest would be in Singapore with about 26% allocation, and the rest is quite well diversified across 10 different countries. Okay, so this is my final slide, just to summarize the fund highlights once more. Firstly, we provide regular income through monthly dividend payments. Absolute return focus enables us to capture opportunities through credit, currency, and rates. And finally, having a long history and a proven track record of delivering stable returns through market cycles. So 2023 is a year for Asia fixed income to shine, and Shenton Income Fund is here to deliver. Thank you for your time. And please scan the QR code to find out more about our Nikko asset management funds, and do visit our booth outside and speak to us if you have any further questions. Thank you.
Okay, good morning everyone. I think you've heard plenty of buy ideas in the earlier sessions already. So this segment is actually a panel discussion where we will be discussing some of the defensive ideas to help you weather through this volatile environment. So even though equities, they have done quite well this year, we cannot deny that the global economy, it is on a much weaker footing compared to the beginning of 2022. If you look at major economies like the US, UK, and much of Europe, inflation rates are still well above their target rates. And on top of that, China's economic recovery is also stalling, dragging down the regional outlook, especially for its export-oriented neighbors such as South Korea and Taiwan, just to name a few. Meanwhile, central banks across the world have been hiking rates aggressively. So in the US alone, rates have gone up by 500 basis points already. And the yield curve is also displaying one of the deepest inversions that we have seen since the 1980s, and recession fears are, of course, plenty. And during times like this, I think many investors like you and I are also thinking of ways to recession-proof our portfolios. So today, each of our three panelists will be sharing one idea on what you can do to recession-proof your portfolios. So I think we'll start with you, Chloe. So in a recessionary environment, I think one of the defensive sectors that people think about when they think about defensive names is the healthcare sector. So why is this the case?
So unlike other sectors, the healthcare sector actually benefits from this relatively inelastic demand for healthcare services, regardless of the economic climate. And if you think about this actually makes a lot of sense, as when most people are sick, they need to visit a doctor or need medication, and this is not something that can be delayed or something that people are very price sensitive to. And because of this inelasticity of demand, the earnings for the healthcare sector also tend to be better protected, and they demonstrate less severe downside, especially in times of softening economic growth. And to add on, I also want to share that we note that the performance for the healthcare sector, it has historically outperformed during periods of market downturns or sell downs, and such attributes would make them an attractive target for investors who are looking for assets that can better able to weather a potential downturn. And not to mention, I think a factor going forward is that global demographics, they will continue to support the healthcare sector's growth in different ways over the longer term. In developed markets, for instance, you will see that an aging population will require more treatments. And in emerging markets, for instance, faster population growth is fueling the demand for more healthcare products and services as societies become wealthier and the middle class also grows.
Right, so I think you've shared quite a lot on the defensive attributes of the healthcare sector already. So what I would like to know is, are there any growth opportunities in the healthcare sector, perhaps any sectors or areas that can deliver longer term growth?
Yeah, of course. So I think like what you said just now, I think many people attribute the healthcare sector to often having these defensive attributes, but the sector does possess some form of growth potential, and a lot of this actually comes from its ability to deliver significant innovation to its patients. So you see the ongoing advances in the development of understanding of new diseases as well as new treatments. They are some of the growth drivers going forward. And if you can see in this chart over here, over the recent years, the number of FDA approved novel drug treatments, they have remained robust. And to actually further encourage more research and development within this space, the regulators have actually helped to accelerate and create new pathways to accelerate the whole review process of the medicines that target high unmet medical needs. And the availability of all these new drugs and new treatments going forward means that it also brings much more options for patients and also brings more monetization opportunities for the companies that are involved. So I want to highlight an area that has been experiencing some form of great innovation, and this is the area of obesity. So drug innovations that are helping individuals manage their weight are the new example of innovative developments that raise hope for blockbuster treatment that can tackle this whole global obesity endemic. And this is a market that is growing rapidly. So I think Bloomberg expects that this market is expected to reach about 44 billion by 2030, and this has grown significantly. If you think that in 2022, this market is only worth 2.5 billion. And not to mention, I think all these medications, they are very important as they come at a point of time where obesity is the most prevalent chronic condition. And there's also an acknowledgement out there that many people are unable to lose significant amount of weight just through diet and exercise alone. And so thus may be in need of this form of treatment. And treating obesity is important as oftentimes it can lead to a number of more serious as well as potentially life-threatening conditions such as your type 2 diabetes or even your heart disease. And where it stands within this whole anti-obesity market, we see two players coming up. This is Novo Nordisk as well as Eli Lilly, and they are vying for leadership within this market for anti-obesity drugs. And their respective experimental drugs and pills have led to a 15% and a 24% decline in weight loss respectively. So naturally, I think investors who do want to take part in the growth of the global healthcare sector should consider the iShares Global Healthcare ETF. And this is an ETF that provides a global exposure to pharmaceuticals as well as managed healthcare or biotech and medical device companies across the world. And on the other hand, if you do want to take perhaps an active approach, do consider the BlackRock World Health Science Fund. And this is a fund that invests in the global healthcare sector through an active approach, as oftentimes when you're trying to invest in a specialized as well as a fragmented sector like the healthcare sector, Having this active approach can be beneficial to actually gain exposure to good quality companies. So all in all, with global economic challenges ahead, as well as much uncertainty ahead, we believe that all these defensive characteristics of the healthcare sector, and not to mention the solid organic growth opportunities that come from this innovation, should actually provide some form of outperformance against the broader market.
Right, thanks, Chloe. So, ladies and gentlemen, I think the healthcare sector isn't really as boring as we thought. So, aside from its defensive attributes, the healthcare sector also possesses many growth opportunities, such as areas like in obesity medications, for instance. So now, I think we can move on to Cyrus. So, Chloe has shared quite a bit on the healthcare sector already. So, Cyrus, do you also have a sector pick to tide through a recession?
Hi, thanks for coming today. So for me, when I look at a recession, right, when I think about a recession, some words come to mind. So it's words like your stability, your resilience, so on and so forth. And when it comes to these type of words, if we focus on US markets, for me, I think the pick is likely to be the consumer staples sector. It should definitely be on top of your radar. And one reason, we'll give a few reasons for that. So the first reason is on margins, and what we notice about it is that gross margins for the consumer staples sector has remained relatively stable over time. So you can see from this chart the margins over time, the 10-year history of margins. Now, the average gross margin of the sectors differ between sectors because of structural differences. But what I want you to focus on is actually on the y-axis, which is margin stability or the standard deviation of gross margins. And one thing we notice is that the consumer staples sector has one of the more stable gross margins. It's relatively low on the y-axis over the past 10 years. And this is actually true even if we break down the consumer staples sector into its constituent industries, which are all in blue color, as you can see from this chart. And on top of that, sorry for that. Yes. So that was on gross margins, and we can see that consumer staples sector generally has gross margins. Now, what about earnings? So what we did in these two tables is actually we looked at earnings in the past 4 recessions defined by NBER, which is the National Bureau of Economic Research in the US. So we look at 2 types of earnings. The left-hand chart, the left-hand table shows the contraction of actual EPS earnings. And the right-hand table shows the contraction of estimated consensus EPS. And looking at the average columns on the right-hand side of both charts, or both tables, I think 2 sectors really stand out to us. And these are your healthcare and consumer staples sector. So healthcare, Chloe has already talked about it quite extensively just now. But I think it's very clear that the consumer staples sector during a recession does pretty well in terms of earnings during a recession. And if you look at this chart, I think this really underlines the case for consumer staples even more. So what we did here is we looked at forward earnings over the past, since 1990, over the past 30 years or so. And we can see that out of the past 32 years, from FY91 to FY22, forward earnings for the consumer staples sector only fell 3 out of the 32 years. And we think that this 3 years out of 32 really underlines the resilience of earnings for the consumer staples sector. So far we have looked at gross margins, we have looked at earnings. So what about performance? So we do the same, very similar table here. And instead, now we look at consumer staples sector performance both before as well as after a recession. And I think, again, it's very clear from the table that the consumer staples stands out for its performance both before and after a recession. And this, again, is alongside the healthcare as well, but consumer staples has done pretty well as well. And overall, I think through the past few slides, I think it's very clear that the consumer staples sector stands out quite a bit. It has a history of stable margins, it has resilient earnings, its performance has held up pretty well both before and after a recession. And looking ahead, actually, we think that investors can continue to expect this type of trends ahead, especially with demand remaining relatively resilient so far. A lot of your consumer staples products are they're essentials, right? So we see from a lot of company reports that revenues have remained quite supported so far. And on the cost side, if we look at a lot of earnings results, companies are reporting a moderation of cost side inflation as well. So overall, I think all these, what we've seen with margins, earnings, and performance can persist even ahead as we look into a recession.
So Cyrus, how would you go about investing in the consumer staples sector? Are there any products that you have in mind? And also, when it comes to the individual stocks, what are some things that investors should be looking out for when they analyze consumer staples companies?
Yeah, so I think if we are looking to invest in the consumer staples sector, there are two main ways. So I think the first sort of quick and easy way, right, is to look for a diversified fund or ETF. So by diversified, what we mean is that it should cover these three main industry groups on the chart on the slide there. So the first industry group is staples distribution. So as the name suggests, it does distribution. These are your Costco's, these are your Walmart's. Think of mainly your main supermarkets in the US. For the second industry is household and personal products. So these are your Procter & Gamble. So Procter & Gamble, for instance, does your Dove, does your Pantene, your shampoo. And these, again, are products that are essential for our daily lives. Third industry is your food, beverage, and tobacco. So these are your Coca-Cola, PepsiCo, Mondelez. So these, again, sell your foods and beverages. And overall, if you're looking for a diversified fund or ETF, what I'll be looking for is diversification. That is the keyword, diversification. Second is, so that was on what to do if you want to look at a fund or ETF. But what if you want to look at a single stock name? So for single stock names, I have two tips for you, two guidelines. First is that the trend is your friend. And in other words, what we should look out for is actually beneficiaries of ongoing trends. And actually one trend we observe, starting from the pandemic, the COVID era, is the prevalence of snacking actually. So I think during the pandemic, a lot of us were studying from home, working from home, right? But what you might or might not have noticed is that a lot of people also started snacking from home while they're working from home, of course. And I mean, personally, I can say that I snack from home when I was working from home as well. But more importantly, even today, when we are all back in the office, we are continuing to snack. This trend of snacking has persisted even past COVID. And if you believe that, if you yourself see this trend of snacking going ahead, picking up going forward, I think you can consider, for example, looking at some snacks companies like Mondelez, for instance. So that was on trends. Now, the second tip I have is to look at pricing power. So before I elaborate into this, I will just give maybe a quick thought experiment for you. So what companies come to mind when you think of these two industries, the soft drinks industry as well as the chocolates industry? Coca-Cola, yes. Any others? Well, I think for soft drinks, most of you have thought of Coca-Cola. Some of you might have thought PepsiCo, Pepsi, of course. And for chocolates, you might have thought of your, let's say, your Cadbury, your Hershey, your Toblerone. Well, the good thing is we have it all in this chart here. So we have Coca-Cola, PepsiCo, we have Mondelez, which owns Toblerone and Cadbury, and of course we have Hershey as well. And what we notice is that for these companies, their products continue to have relatively low elasticities. So what that means is that they can raise their prices without hurting their sales volume too much. Or in other words, in very simple terms, they have pricing power. And this is due to many factors, of course. I think some of the key factors include very strong branding. I mean, Coca-Cola and Pepsi, they're very well known for their beverages. I think everyone knows them whether you invest or not. And as well as their very large market share. Again, looking at Coca-Cola and Pepsi, both of them take about 70-80% of the global carbonated drink industry. And what this means for you is that because of this pricing power, a lot of them, these four companies, have seen very strong organic revenue growth in 1Q23. So you can see that it's all double-digit organic revenue growth, and most of it is actually driven by pricing, which is how much they have increased their prices. And to us, this strong pricing power is very important. It helps to sustain the organic revenue growth of these companies, and it's especially good, especially in this current inflationary environment we live in, where companies need the ability to raise their prices to keep their margins supported. Yeah, so overall, I've looked at quite a number of topics. I think overall, to summarize, if there are two ways of investing in the consumer staple sector. So first is through a diversified fund or ETF. So for this, our recommendation is a Consumer Staples Select Spider Fund, which is a passive ETF with an exposure to 37 US large cap consumer staples. So it's all your global leaders, like what we mentioned earlier about your PepsiCo, Mondelez, Coca-Cola, so on and so forth. All your global leaders are there. And its expense ratio is pretty attractive, 0.1%, very relatively low, and it has a distribution yield pre-tax of about 2.5%. So again, for the ETF fund segment, we recommend diversification, and this is our recommendation. Second option was to look at individual stock names. So for this, we have identified PepsiCo and Mondelez. So we think that for individual stock names, again, we want to look at beneficiaries of ongoing trends like snacking. So PepsiCo has your Lay's potato chips, Mondelez has a lot of your chocolates as well. So these are beneficiaries of ongoing trends. And they also have a very strong pricing power, as we saw in the slide before. So these companies we think can do pretty well in this recessionary environment. So I think that's all for me today. Hopefully I've given you all some food for thought to prepare your portfolio for a recession. Look forward to any questions you have at the booths outside, and maybe you'll find me snacking outside. Thank you.
Okay, thanks, Cyrus. I think to sum things up, you've mentioned quite a few points already. So I'll do my best to summarize some of the things you mentioned. So companies in the consumer staple sector, they should possess two main qualities. One is stability, the other is resilience. So stability in terms of stable margins, and also resilience in terms of resilient earnings, especially during a recession. And also plus points for companies that benefit from ongoing trends and companies that possess pricing power. Right? So I think we've heard two great ideas from the equity space already, but an investment playbook on a recession, it would not be complete without a discussion on bonds, especially when bond yields have never been this high for so long already. So historically, long duration bonds, they tend to outperform in a recession. So Hui Shi, my question to you is, with inflation still running high, do you think bonds are still able to serve their intended purpose?
I think yes, definitely. I think bonds, they are still able to serve their intended purpose in a recession. So on my chart over here, with central banks hiking interest rates at the fastest pace in decades, you can also see that bond yields across the maturity spectrum has increased to levels that we haven't seen since 2008. And with more than 1 year into this rate hike cycle, I think it's really hard to ignore the fact that income is finally back in fixed income. So what this means is that fixed income now offers improved opportunities for income generation and can also provide investors with a greater margin of safety. So for investors who do include bonds into your portfolios, I believe that you should be able to enhance your risk-reward ratio. While the attractiveness of bonds is indeed increasing, I do also want to mention that it still remains very important for us to manage our duration risk. Even though recession models, they are currently flashing red, the Fed had signaled for even more rate hikes by the end of this year and has also pushed back expectations of a rate cut. And this is because inflation in the US, it is running high and it's also sticky. So if you recall the CPI figures for the month of May, the headline inflation was at about 5.3%, and that was actually even higher than the core inflation was about 5.3%, and that's even higher than the headline inflation of 4%. And besides that, history has also shown that once inflation breaks above the 5% mark, it will usually take years for inflation to get back down to the 2% central bank target. So under such circumstances, for us, we will continue to prefer short duration bonds. Short duration bonds, they are less sensitive to the interest rates changes, and they can also allow investors to lock in attractive yields without taking on greater duration risk. And based on the chart that you can see on the screen here, it's pretty clear that short-term bond yields, they have moved up a lot higher as compared to the long-term bond yields. And for the yield curve, it also remains deeply inverted since short-term yields, they are now a lot higher as compared to the long-term bond yields. And in my view, I think that investors, they will increasingly ask for greater compensation to hold the longer dated bonds given high inflation as well as record debt levels. So even though the US debt ceiling crisis, it is now behind us, for now, I think that investors will ask more compensation to hold the longer dated treasuries, given the risk of another future breach of the debt ceiling. I think the 10-year treasury yield could stay elevated in the near term, and it can go beyond 4%. And at that point in time, that would be a more attractive entry point for investors to consider adding some duration into their portfolios.
So Hui-Shi, I think you've mentioned that bond yields have risen in both the investment grade and also the high yield space. So where do you see more value in, and what are your reasons?
I think it's pretty clear that high yield bonds, they do offer very attractive income, but I think that a more defensive positioning, it is more important in a recessionary environment. And you can actually take a look at the yield premium between high yield bonds as well as IG bonds, and you can see from there that IG bonds, they are offering much more value compared to the high yield bonds. So this yield premium, which is the yield spread high yield bonds have over IG bonds, it is below the long-term average and is also far from past recessionary levels. And ideally, investors should be getting a higher yield premium on high yield bonds given the greater credit as well as default risk as the macro backdrop weakens. So for us, we prefer to stay higher up in quality. We prefer IG over high yield, as investors are still able to capture the higher yields from fixed income by staying within the safer IG segments. But for investors who still want to retain some exposure to high yield bonds, I think that you should adopt a more tactical strategy by going for high quality high yield rather than chasing yields from the lower quality companies which are more likely to default. And by high quality high yield, I'm referring to bonds with a credit rating in the BB segment. And meanwhile, for investors who are happy to stay within IG, I think you will be able to receive rather attractive yields of about 4 to 5%. And to give you some color, some of our recommended funds on our platform, such as the Nikkei AM Shenton Short-Term Bond Fund and the United SGD Bond Fund, they are very viable options, providing yields of about 4 to 5%. So for the United SGD Fund, it seeks to beat the Sing dollar deposit rates and also aims to provide higher yields compared to most of the money market funds. And whereas for the Nikkei AM Shenton Short-Term Bond Fund, it mainly invests in a diversified portfolio of good quality short-term bonds as well as money market instruments. And I do have to say that for this Nikkei AM fund, it has a very attractive yield to maturity of slightly above 5%, and also with a high credit quality of A-. And for us, we do like short duration bonds, and both of these funds have relatively short durations of about 1.1 to 1.2 years. And with that, I hope that you have gained some insights about some of the opportunities in fixed income in a recessionary environment.
Yeah, I guess for the longest time, there was no alternative to equities, but with such compelling yields coming from the fixed income space, I guess it's safe to say that bonds are indeed back. All right, so thank you Hui-Shi, Chloe and Cyrus for sharing your ideas. Before we wrap things up, here's a summary of the items that have been discussed. So in terms of asset allocation, we do have a preference for fixed income over equities. Like Hui-Shi mentioned, we particularly like the higher quality bond space and also shorter duration bonds. So as the recession looms, we do prefer higher quality as a more defensive positioning may be warranted. And also for short duration bonds, short-term bond yields have risen significantly compared to their longer duration counterparts, and this also allows investors to receive greater yields without having to take on higher duration risk. And as for equities, we like sectors like healthcare and also consumer staples as we head towards a recession. And the reason is not only do these sectors, they possess defensive attributes, but such as stable margins and also resilient earnings. But on top of that, they also have certain sectors that have the potential to deliver longer term growth. So ladies and gentlemen, I hope that this session has been useful to you. You have managed to gain some interesting insights on how to recession-proof your portfolios. Thank you for listening, and please enjoy the rest of your day.